Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Percent is and will remain our inflation target.
It's critically important that inflation expectations remain anchored at 2%.
If the right inflation target is 2% and they want to get there in a credible period of time, then we are not sufficiently restrictive.
We have to get inflation down to 2%. We all agree on that. We're all committed to that. The question is how to get there.
If we're stabilized around 2.5% and the economy is humming along, are you really going to break it?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The last week of August, where did summer go? Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Farrow, together this morning with Katie Lines. Your S&P 500 positive by 0.1%. That line from Chairman Powell, 2% is and will remain the inflation target of the Federal Reserve. Tom, is it and will it? Still a question out there for many people on the sidelines of Jackson Hole.
A little bit of humor there as well, as they're at 2%, and Dr. Coronado's up to 2.5%. But that's the raging debate, and I would suggest, John, some real disappointment at Jackson Hole that this was not addressed in the papers. It was not addressed more intelligently, I should say, about how do you get to where you determine that rate. It was devoid there.
The neutral rate.
All these distractions.
Kind of batted away by Chairman Powell.
Batted away, perfectly said.
In the speech.
Yeah.
This is something that came about. That expectation existed, Tom, because inflation data, yes, has made progress, but is still elevated. And output, GDP growth, this economy is still outperforming, even with rates of 5.5%. And I think that's what's introduced, Tom, this conversation coming into Jackson Hole, but clearly not something Chairman Powell wanted to entertain.
I don't want to derail the opening, but I look at one number, the 11 ratio. The 11 ratio Bloomberg Financial Conditions Index does not scream restrictive. It screams nicely accommodative. The chairman has failed, not like a personal failure, but the Fed has failed to get us to a restrictive statistic based on Michael Rosenberg's great academic work.
One thing the chairman entertained was the prospect of doing more. Katie, we discussed it in the last hour. You go through that speech piece by piece on the economy. At the end of that, he suggests the prospect of doing more. On the labour market, at the end of that, he raises the possibility of doing more. And then at the very end of the speech, he starts talking about, what was it? I've forgotten that line.
Navigating under the stars, but it's cloudy.
Something like that, yeah.
Something very poetic. But it seems like the message was... Sorry.
This is how it works, Kaylee. You just carry on talking and you'll get this bed of disruption. Sometimes singing, sometimes it will make sense. Other times, quite often, it won't. But you just keep going.
Don McLean, a few years ago.
Okay, good to know.
My takeaway from the chairman...
no idea who Don McLean is. No clue.
She's not alone.
Yeah, you're right about that. My takeaway from the chairman was there is a lot that they don't know. However, their bias is still going to be to do more rather than to do less because they are trying to win this battle. And to your point, John, him talking about the economy, talking about above trend growth and how that could actually be problematic, and the inflation fight and the resilience in the economy. We're talking about the idea of a soft landing. That could be not a good thing for this Federal Reserve.
Katie, well done. That was good. Thank you. You got through it.
Thank you very much.
You got through it.
Should I hum a few bars or something?
If you can. You want to sing some lyrics?
Yeah, no, I don't think I can.
No, I didn't think so.
I'll leave
Let's
that
get to the price action on the S&P 500. Equity futures right now positive by 0.2%. Over in China, a big effort to put a floor under this equity market. Tom, they're cutting stamp duty on stock purchases for the first time since 2008, limiting IPOs. Based on our reporting this morning, they're even asking some mutual funds not to sell more stocks than they buy, and yet that stock market had a move of more than 5% and closed higher by just 1 point something.
Yeah, you know, it's a day-to-day grind in China, and at some point they're going to blink based off economic data. And I thought about this early coming in with the Bentley this morning, John. And the basic idea to me is if China gets a run rate sub 5%, even 4.8% or 3.8%, guess what? When the facts change, President Xi's going to change.
Well, here's the fact right now in the bond market, 5.1%, Kaylee, yields up by 2 basis points on a 2-year to 5.1%. 2.1%.
Yeah, as we beat the drum to September and whether or not we're going to see a hike or a pause at the Federal Reserve and maybe one at the ECB as well. We've talked at length about how Christine Lagarde gave no clues about what is coming in that September 14th meeting, but we'll look for more clues from other members of the Governing Council. Just about an hour from now, 8 p.m. Eastern, we'll hear from Joachim Nagel as well as Robert Holtzman speaking in Austria. Of course, we already heard from the latter. He gave an interview to Bloomberg this morning in which he said he does see a case for a rate hike if no surprises turn up. At 10 a.m. Eastern time, back in Washington, D.C., there is a hearing in Trump's federal 2020 election case. We are expecting a trial date to be set today. The DOJ is looking for January 2nd. Trump's defense team is looking for August of 2026. So we'll see where maybe in between those the judge comes down. And finally, also today, Secretary of Commerce of the U.S., Gina Raimondo, is in China. And we actually just are getting some headlines out of her speaking in Beijing. She says trade can bring stability to U.S.-China ties. It is profoundly important to manage that relationship. She also spoke with her counterpart in China, the Commerce Minister Wang, for more than 4 hours, in which they discussed strategic interests, agreed to communicate regularly, and agreed to launch a platform on export control info. So we'll see what else tangible comes from her visit there that lasts until the 30th.
Katie, would you say that one of those individuals is sitting in a stronger position than the other, given what's happening with their economies at the moment?
At the moment, it looks like China may be negotiating or at least talking from a position of relatively more weakness, given the fragilities that exist in that economy and their stimulative efforts, their attempts to address it that haven't yet seemed to really stick to this point.
Falling flat. Katie, thanks for that. More on that a little bit later. Joining us now, Sam Stovall, Chief Investment Strategist over at CFRA. Sam, wonderful to kick off this hour with you. You've got this line in your research, September's slippery slope. Can't believe we're closing out August already. Sam, what is September's slippery slope?
Well, good morning, Jonathan. In terms of the slippery aspect, what is it that's going to cause possibly share prices to continue the digestion of gains, I think is the uncertainty surrounding the coming FOMC meeting. Also, the PCE data this week that could end up showing a backward uptick on year-on-year for headline as well as year-on-year for core. And that's going to give additional reason why September is the only month to decline more frequently than advance.
Sam, your history is to get beyond the moment, get beyond September and, dare I say, even Q4. Are we looking to a second leg of a bull market?
Good question. I think so, Tom. When you look back to the election year of all first-term presidents since World War II, the market has never declined. So that's not a guarantee, but it certainly is a comforting statistic to say, there's a good possibility that the market will be higher next year as well.
The chairman is looking at the stars in Jackson Hole. You and I are the only ones that remember Don McLean and Vincent. Clearly, Kaylee and John don't. So let's go there, Sam. You own the stars. Is the migration from 4 to 5 stars, or are you seeing more star downgrades at CFRA?
I think we're holding still right now. We have essentially all of the sizes, styles, and majority of sectors below their 50-day moving average, and 5 of the 11 are below their 200-day moving average, along with small cap stocks. So I still think there's a little bit of digestion of gains that is in order, but I think that we are going to experience a recovery come the fourth quarter of this year. I don't think that the Fed will be raising rates in September, but we do see the possibility in November. But then our belief is that will be the last one for this cycle.
Okay, but it's one thing for the Fed to stop hiking, Sam. It's another for the cuts to start. When do you anticipate that might happen? Does the equity market have a little bit of over-optimism on that front?
I think that is a possibility. Higher for longer relates not only to the Fed's rate tightening program, but also for the year-on-year change in headline PCE. We don't see it approaching the Fed's target until the end of next year. So the real question is, how long will they maintain an elevated interest rate? Typically, the span between the last rate hike and the first rate cut is 9 months, and the market does exceptionally well in that pause period. But this pause period has continued to be moved out. Our earlier expectation was sometime in the second quarter of this year, but now apparently it's 6 months later.
Okay, and we know that the Fed's decisions are going to be informed by the data. They are data-dependent Fed. Are the catalysts for the equity market also likely to be economic data more so than anything else? Are markets too also data-dependent?
Well, I think that they will need to have confirmation from the data. Prices lead fundamentals, and I think that's one reason why the market has done so well so far this year, even though expectations are for a flat to down earnings year in 2023 when all is said and done. Expectations are for a 12% advance in 2024. So I think we need to actually start to see earnings improve. We're expecting actually the third quarter at about a 5.5% decline. I'm sorry, the second quarter at a 5.5% decline to actually be the 55th of 57 quarters in which actual results exceeded end of quarter estimates. And it's likely to be the same story for the third quarter, which is expected to be off by less than 0.5%. So things are getting better from a fundamental perspective.
Hey, Sam, thank you. Sam Stovall there of CFRA. Closing out August and looking ahead to September, which kicks off on Friday. Can't believe how quickly that's come around. Let's bring up one name, one stock. Hawaiian Electric Industries. We've just had a statement from its subsidiary, Hawaiian Electric, a statement addressing the fires in Lahaina. I just want to bring you a couple of paragraphs, some quotes from this. Hawaiian Electric says in this statement that a, quote, morning fire on August 8th appears to have been caused by power lines that fell in high winds, that the fire department responded to and reported was 100% contained. Then in the afternoon, according to this statement, its power lines in West Maui had been de-energized for more than 6 hours. A second fire, referred to as the afternoon fire, began in the same area. And Katie, from what we understand, the cause of that fire hasn't been determined. That stock is up by 35%.
It is, but remember, this is after a 72% decline we have seen in this name since August 8th, when that fire happened in Lahaina, because of the concern that this company was going to be found liable, that we could see something akin to what we saw with PG&E in California, where the legal liabilities would be in the billions of dollars should they actually, their equipment rather, be found as a reason why the fire had spread. It seems like what they are trying to address in this statement is that that is not the case, at least for the later fire that then, of course, had horrific, catastrophic, deadly consequences.
To me, it's almost too early for these kind of discussions because I think the horror of what happened is still with us. But I'm fascinated how the tourist industry of Maui rebuilds. I don't know what that'll look like.
The latest on the wildfires in Hawaii. More on that a little bit later. If you are just tuning in, welcome to the program on the S&P 500, positive here by 0.1%. Elsewhere in the bond market, yields basically unchanged on a 10-year at 423.55, on a 2-year. The 2-year yield at the front end of the curve up by 2 basis points to 5.1%. Why didn't you just say he was the American Pie guy? Why didn't you just... You know,
I know the song.
We all know that song.
Don McLean, what's stunning to me...
We could have sung along with you. It could have been a big moment for this program.
For 8.5 minutes.
We lived this, and Don was legit from day one. He had an incredible craft. And what was interesting was the hugeness of American Pie. I mean, I remember when colleges literally had courses where you would take a course and tear apart American Pie. But there were so many other songs, somewhat like Gordon Lightfoot, but even more so. Lightfoot never had the ginormousness of American Pie. There were these other songs, and, you know, alluding to Chairman Powell's comments, this was Vincent, which was, you know, it was a dated ballad. This is 52 years ago, Kaylee. This is a few years back.
Yeah, 1971.
Don McLean right now is 49 years old.
I was negative a couple decades at this time.
TK, aging yourself.
Grandma would never say that, you know.
Tom was in the clubs in the 60s. Got to share some of those stories, Tom. They're good stories.
I talked to my father the day Neil Armstrong died, and he said to me, we were so lucky to live that generation. I feel that way about music, and that we were so lucky to be. I remember, I have the clearest memory of sitting on Mike Hasenauer's bed looking at Sgt. Pepper's going, are you kidding me?
You said
just as one story.
You're not a fan of the auto-tune music these days, because I'm totally on board with you.
When you sing like I do, you're a big fan of auto-tune. That's a different story. But the answer is yes, some of the songwriting craft is...
Lost?
Lost.
Kenny Nixon and Northern Trust coming up from New York City. Good morning.
the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
On the next episode of The Circuit.
And I've heard you say you were really motivated by the fact that a lot of people didn't think you could do this.
I think even today I'm underestimated. And I think even today Bumble is underestimated in terms of what we can be and what we can do in the world.
Watch The Circuit now on Fire TV channels.
We can continue to maintain strong consumer spending, real wage gains, a tight labor market, and continue to ease off on inflation. That's certainly been the pattern over the last few quarters. And so as long as we can maintain the tight job market and continue to see inflation ease, I don't see why those trends can't persist.
That was the political view, the outlook from Jared Bernstein, the chair of the White House Council of Economic Advisors, speaking to Bloomberg going into the weekend. Fantastic to see Jared over in Jackson Hole, and good morning to him as well, Tom. He is a regular listener to this program.
He's an important voice. He's been a huge supporter of what we've done for well in excess of 20 years. He's a perfect example of the power of Washington and America think tanks. He drove the bus at Economic Policy Institute and the Center on Budget and Policy Priorities. It was an inspired selection by the Biden administration. He was the liberal think tank economics guy, John, that the conservatives were forced to read.
I'd like to hear more from Jared as well.
Yeah.
Robust exchanges whenever you hear from him.
Yep. He's
always.
The conservatives always read Jared Bernstein.
Well, as he's talking, though, about the Biden administration and the idea that inflation is coming down, he's confident it's going to stay on this trajectory. I'd like to recall the conversation we were just having last hour with Mohammed Yunus of Gallup, where the president has 37% approval on the economy. No matter what the economic data is saying, the feeling of the American voter base is different.
Yeah.
And let's get to that right now. The blended number, all in, away from the economy, Ukraine, and race relations, is the president of the United States with a sterling approval rating of 42%. That leads to a conversation the end of August and into the autumn. Anne-Marie Horton joins us now. Bloomberg Gallup, Washington correspondent this morning. Anne-Marie, Gallup carries a certain authority, as we did when speaking with Mr. Yunus as well. Color for us, what does a 42% approval rating mean for this president?
Well, I think the issue is more what Kayleigh just mentioned. It's the approval rating on the economy, which is actually lower than his overall approval rating. And when you look at where we might be in November of 2024, the economy still is ranking high on individual issues and why they go out and vote and how people feel about this economy. No matter what Jared Bernstein wants to talk about when he talks about the data and some of the good data we've seen in the U.S. economy, the fact is that is not how people feel. And that is because they are paying higher prices, and they continue to pay higher prices, even though the rate of inflation is coming down, for their basic necessities, like rent, like groceries, like gasoline. And that is the issue this president faces. But I'd bring you to another poll this morning from the AP, which overwhelmingly shows many Americans just feel this president is too old to be running again. And they also didn't have the nicest things to say either about his potential rival, former President Donald Trump, if he was to get the nominee.
Emery, what is the Biden plan, or I should say point of discussion, to get to the first Tuesday of September? Where do they want to be coming out of Labor Day?
Well, the president just got back from his holiday, his trip in Lake Tahoe. And right now what you see from the schedule for the week is he's going to be touting these similar agenda items we have heard through the president throughout the year. They are trying to sell, I'm even seeing ads on television, they are trying to sell the Inflation Reduction Act. Because remember, when you look at the polling for the Inflation Reduction Act, Americans don't really understand what it means and how it could help them or benefit them. It would benefit them if you had the availability to buy a brand new EV or the money to upgrade your roof to solar panels. These are some of the rebates that are in it. But they are still trying to explain everything they've done. So things that will come up this week, obviously they're going to have a speech regarding the 60 years on from the March on Washington. They're going to be talking about how they're allowing Medicare to now really go back to the drug pricing, to the pharmaceutical companies to talk about drug pricing. And of course, they're going to talk about selling the Inflation Reduction Act, the CHIPS Act, as well as hard infrastructure. All of this will be a continuous theme to November of 2024, and they try to encompass all of this as Bidenomics.
Of course, Anne-Marie, Biden hasn't just been touting Bidenomics. He has also been touting himself as a pro-union president. And as Tom asks about the month of September, September 14th, or really after, could be a pretty rough time for this administration and the economy overall if we see the United Auto Workers actually go on strike. Given their demands, a 46% pay raise, a 32-hour work week, how problematic could this get?
Yeah, not just that. They really also want to make sure EV workers, when you see these companies really start to expand in the EV production, because of some of the work and the legislation the Biden administration has pushed through, they're starting to build up these battery plants, and those workers are not unionized. And that really bothers the UAW president. The UAW has authorized, the workers have authorized their leaders to strike if they do not get the deal they want. And right now, it is miles away between what the UAW is asking for and what the car companies say can be done to make sure that the car companies are still competitive. But these UAW workers feel like they've gotten bad deals for years, and they want to make up for lost time. And a lot of them definitely feel left behind. We know that this has drawn a lot of stress within the White House, because the president already has spoken about it, and he's put out a statement about it. And we've spoken to the president's former labor advisor, who helped him coin the term that Biden was going to be the most pro-union president in modern times. And that individual, Mr. Harris, he thinks that this is going to be a strike, and that's going to be incredibly difficult for this administration.
Tom always told me that people don't wake up in Washington, D.C. before 8 a.m. Are they starting drilling in the D.C. studio at 7:22?
Well, we're facing an election November 2024. Kaylee and I have asked for some upgrades, so yeah, they start as early as I do.
Okay. AMH down in Washington. Anne-Marie, thank you. Katie, you have to put up with that every single day?
Yeah, often.
In the studio?
Reno.
What are they doing?
It's actually the ceiling of the studio. I think it's the floor above. In D.C., it's a smaller operation. We don't have the whole skyscraper like we do here in New York, so it's
Are you getting a second floor? It's just someone above?
I think it's someone above.
Okay. Great.
Yeah.
TK, the latest down in Washington. I think Katie's right to focus on the demands that we're seeing from Detroit at the moment. And Lisa's mentioned this a few times over the last week. We've seen a lot of evidence of labor power over the last year. Agreements for UPS, agreements for American Airlines. What we haven't seen are big strikes. And Tom, the potential for that to happen across Detroit's big three from the middle of September is something we can't ignore going into September.
And the downtime of strikes, I wonder if we haven't seen big strikes because there's a huge cost estimate of what those strikes mean for UPS or whatever as well. So they come to an agreement, they come to a solution. And I don't know where, within a 32-hour work week that
where is the
clicks
agreement?
in for Detroit or Dearborn. But the answer is these are bold demands. And yet there's probably a huge, I don't know, do they want to strike? I mean, I don't know what the individuals, what I know in the zeitgeist of here of August, all of a sudden EVs, I guess, aren't selling like they used to sell.
Well, but this really is the question. This is supposed to be energy in transition, and theoretically an American workforce that is going to have to transition along with it, but these workers want to be protected. And what you hear from the administration is that there has to be a way for everyone to win, but this is going to get much more difficult to broker if we're September 10th, September 11th, September 12th.
Which side is the White House on?
Exactly. And do they actually have to get involved with just an acting labor secretary in Julie Su, who, of course, still hasn't been confirmed?
Well, we got to get to September 11th, but first we got to get through September 2nd. And, John, you know what September 2nd means. I mean, it's a big football game, not in Knoxville.
Okay.
It's in Nashville. It's UVA versus Tennessee, number 12 ranked Tennessee.
And not ranked.
UVA does not have a good football team.
No.
You're a basketball. You're a basketball college.
Basketball, swimming, soccer, lacrosse, tennis, basically
but
everything
this is
else.
Inspired. Matt Gagnon, bring it up again on radio, folks. This kid is 34 years old. He's a walk-on graduate student at UVA, an ex-Marine helicopter pilot. I'm sorry, this is so cool. I got
That's
goosebumps.
very cool. You're
34-year-old
educating me
kicker.
on this. I didn't know.
Well, that's because you only pay attention to UVA basketball. But John, I love this idea. Like in my youth, they let the kids from Vietnam come back and play college football.
That's cool. I like
23,
that.
24, 25. This kid's 34, a graduate student at Darden, and he made the football team as a walk-on.
So you're saying there's a chance that we could go back, you could play ice hockey again, and I could play Division I soccer?
No one's calling
No,
it
Tom's
the
going
thing.
back to caddy.
Yeah, exactly.
You can caddy for the golf
but
team.
I'm
Also
sorry,
very
this
good.
is inspired as well. I mean, this is enough to get fired up and beat the dreaded Orange of Knoxville.
Is that a big game? I can't get excited about that.
No,
UVA
I don't. They play
Knoxville.
Duke late in the season. I guess that's a big game.
Would you go and watch that kind of game? No, no. You see, Katie wouldn't even turn up for that game.
No, she wouldn't. You know,
Basketball,
the ladies,
definitely.
The ladies of UVA at Bloomberg are all basketball.
Sonia Miskin of BNY Mellon coming up shortly from New York City. Equities positive by 0.2%. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly with just a couple people. Our average restaurant now does about over $1 million per restaurant in digital sales.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
The opening bell a couple of hours away. Going into that, your equity market to kick things off this Monday. Slightly elevated on the S&P 500, up by 0.2% on the S&P. On the Nasdaq, up by about 1/3 of 1%. Doing our best over in China to stimulate this equity market. Cutting taxes on stock purchases for the first time since 2008. Limiting IPOs. Telling some mutual funds, according to our reporting, not to buy, Tom, in fact, not to sell, and not to sell more than you're buying. Effectively is the message coming out of China, and yet still the CSI 300 popped 5% and some, and then faded big time into the close for a gain of just 1%.
Let me editorialize it. I'm a huge fan of the former governor of Rhode Island, but forgetting about that, John, rule number one of diplomacy, including having Ambassador Nicholas Burns over there, is show the flag, even with all the debate. And I'm enthused here in that we're getting up and saying, let's go. And I believe it's a 4-day trip. It's not just over and back. This is like some serious commitment here by a set of officials to maintain the dialogue under maximum stress.
So let's get straight into that conversation. Under surveillance this morning, U.S. Commerce Secretary Gina Raimondo in Beijing, looking to expand business ties in China throughout this week, as Tom mentioned, through Thursday. The Secretary of Commerce telling her Chinese counterpart the following, quote, "It is profoundly important that we have a stable economic relationship, which is to the benefit of both of our countries and, in fact, what the world expects of us." Raimondo would also go on to say, of course, in matters of national security, there is no room, Katie, to compromise or negotiate.
This is what we continually hear from the administration, is that the aim is to protect U.S. national security interests. It is not to hold China back economically. And we actually were hearing from the Commerce Secretary speaking just in the last hour, and she said Chinese economic growth is in global interest, but it speaks to the difficulty, the needle you have to thread when the U.S. is trying to protect national security interests, and in doing so proposing various restrictions on outbound investment into China, on specific tariffs that are still in place, while also not trying to poke at a very fragile economy and risk the ripple effect that could hit the U.S. as well.
Katie, to your point, I think we're on the same page. Tom, it is in nobody's interest, from purely an economics perspective, for China not to deal with this in an orderly fashion. We need them to be able to deal with this in an orderly fashion from a global economic perspective.
We began strong in Jackson Hole with Adam Posen on this at the Peterson Institute. Just the two essays in foreign affairs, folks. Dr. Posen of the Peterson Institute and Ian Johnson writing on it shows the absolute immediacy to be knowledgeable and to address this and to interpret the reaction that we see, or reactions, plural, that we see out of Beijing.
It feels so strange to say this, but we get the payrolls report for August on Friday. September is just around the corner.
That's very strange. You'll be here.
I wanted to give you a sneak peek of the number, and we'll talk about whether we're here or not in a moment, Tom. Just shy of 170,000 jobs in August is the estimate. Unemployment expected to hold at 3.5%. The average increase in job growth over the past 3 months would be the smallest since the start of 2021. Just seeing that deceleration, Tom, and that's the objective. So we're told at the Federal Reserve.
I'm going to go to David Kelly of J.P. Morgan, who I think Dr. Kelly makes clear there's a negative payroll statistic out there somewhere. And I don't know where it is, but we're taking our sweet time to get there.
Won't be here Friday.
We won't be on Friday, but
you'll be here Friday.
I'll be here on Friday. I'm looking forward to it. I don't, the kids are like, they're back. They're like in their school thing, and they're like worrying about this and that.
September weather in New York is the summer equivalent in
John,
the UK. If we would dream of a summer like the September you get in New York, I'm not letting go of summer. I do that every year. Hold on to it.
John, we go to Jackson Hole. We come out from the walk-up that I have in Manhattan, the leaves beginning to change across Central Park.
You love that,
just the autumnal change that we're beginning to see.
What is it? Leaf peeking? Leaf peeping? Okay.
Leaf peeping. I was leaf peeping.
In Japan, Momiji
Just a little.
Yeah.
Oh, very good.
Good stuff, thanks. Let's finish on this. Florida's Gulf Coast preparing for tropical storm Idalia. The storm is expected to make landfall on Wednesday as a Category 1 hurricane. Some areas of the state could see as much as 10 inches of rain and flash flooding later this week. And you're reminded, Katie, in moments like this for Florida, that Governor DeSantis has a day job.
Yeah.
Has a day job away from the campaign of trying to become the next president of the United States.
Yeah, and he's going to have to step away from that campaign effort this week in order to address the potential crisis that Florida is facing, as well as, of course, the aftermath of a shooting we saw in Jacksonville over the weekend. So he is in Florida for the time being, as he is languishing as well in the polls as he tries to campaign for president of the United States.
Tom, it's that time of year, hurricane watch in Florida.
Yeah, and it's going to be serious here with the summer that we've had. The pros are telling us pay attention to this. We'll do that with Rob Carolyn giving us terrific weather perspective. On the weather of central banking, Sonia Meskin is hugely competent. Head of U.S. macro at BNY Mellon. She's had the toughest job in economics, which is advising people at the New York Fed about the real world. Sonia, what was it like advising people at the New York Fed? That is the crucible of foreign exchange and market analysis, given all the Fed blah, blah, blah. What was it like in that job? I mean, how do you survive day to day at the New York Fed telling smart people what to do?
Well, it was super interesting. I think one of the key takeaways, of course, is the relationship between economic fundamentals and financial markets. And sometimes they're tightly connected, and sometimes they're quite divorced from each other.
Right now, the word for me at Jackson Hole was complexity. How much is the complexity that you see right now? Gauge that.
Oh, an enormous amount. And I think that most speakers admitted it, included Chair Powell. It was quite interesting for me also the things that he did not discuss that are also complicating the picture. For instance, the situation in China, how does that play into the Fed's reaction function? Our fiscal expansion, how does that play into the U.S. Fed, the Fed's reaction function? And finally, what's going on in the labor market? Are we seeing structural changes, or are we seeing still the percolations from the temporary COVID shock?
Well, Sonia, to the point on the labor market, the resilience we have seen there, supply and demand, which still seems like it is mismatched, even as the Fed talks about progress toward making it better balanced. But combine that with also the above trend growth that we are seeing and that the chairman talked about. How much longer can either realistically last? When do those lagged effects of tighter policy really start kicking in?
Well, that's a great question, of course. And as you guys just mentioned, even though we're expecting smaller gains in payroll numbers, the unemployment rate is still very, very low. Again, precisely the point that our fiscal policy is actually expansionary. And so I do think the strength may persist into the next year. But then, of course, higher rates do at some point begin to bite more, especially as corporates begin to refinance into a higher rate environment.
But do they begin to bite enough that the Federal Reserve is actually going to have to turn around and start easing policies, Sonia? What is your expectation on 2024 and whether any rate hikes could actually come?
Well,
or cuts,
we do
rather.
expect that to. Yeah, we do expect that to start happening next year, but we also believe that, of course, the Fed will have to upgrade its growth forecast, its inflation forecast, and downgrade the unemployment forecast come the September meeting this year. And that would entail also some upgrades for 2024.
Sonia, when I look at where we are, we have to stagger the meetings. How do you look at the September-ish meetings of different banks? Or are you looking out to November, December, and dare I say the first meeting of 2024?
Yes, of course. And the divergence that was discussed at the Jackson Hole meeting, the global divergence, is going to be quite important as well for our forecast, because, of course, the U.S. is doing quite a bit better than Europe and China at the moment.
Well, you know, I guess it's there, but, this didn't really come up at Jackson Hole as Jerome Powell is central banker to the world. I mean, Lagarde made a splash and Ueda showed up, which was all great in that. But give us the level of internationalness of Jerome Powell right now after Jackson Hole. Is he really central banker to the world?
Well, he has to be to some extent, right? We've witnessed this, the impact globally, recall 2013, when we saw considerable outflows from the emerging markets, when, balance sheet tightening started getting discussed. And again, in 2018, when the Fed began raising rates. So I do think that the emerging markets, for instance, are better prepared today than they were in those two previous instances, but it's still a risk to them, of course.
What about China specifically? You just mentioned how the U.S. is doing better than both Europe and China. Given some of the efforts we have seen, attempts at trying to stabilize things, to stimulate the equity market, or at least put a floor underneath, how much further do you think China actually needs to go to accomplish that goal?
It's a very difficult situation that they're in because they're trying to deliver in an orderly fashion, which is always difficult to do. It is especially difficult to do in an economy that is not, especially market oriented and has tight capital controls. So it's definitely, I think, a risk for the global outlook.
How large a risk, though? What kind of ripple effect, realistically, do you think the U.S. could feel or Europe could feel if the fragilities in China maybe get worse?
Well, first of all, through trade, of course, but secondly, also through global financial conditions. I think both of those are important.
Sonia, great to get your perspective on things. Thank you. Sonia Meskin there of BNY Mellon Investment Management. If you are just tuning in, welcome to the program. Tons of feedback on the Powell speech on Friday. Tons of reaction, including this from Stuart Kaiser of Citi, publishing yesterday evening. Allow me to share this quote with you. It's important. He says, the combo of solid labor markets and downtrending inflation is good for risk assets. But here's the punchline. Keep it simple until that changes. But comments today suggest that changing is the desired Fed outcome. And if you go through the content of that speech, Tom, the actual substance of it, it's the need for below-trend growth. Don't have it right now. It's the need for this labor market to ease even more. Perhaps you'll see that on Friday. But that's the objective from Chairman Powell and this Federal Reserve.
They're data dependent. They may get some data here on disinflation. It's soft landing, but I've sort of felt the idea out there was within the data dependency, unlike in Europe, there's no real aggregated slowdown in America. Again, don't tell that to have to. The president's got a 42% approval rating. Clearly there's a slowdown going on, but not in the markets.
Do you remember that line about cumulative lags, cumulative tightening, and the lags of policy from the former vice chair?
Dr. Brainerd wasn't there.
Powell
I wish
alluded to
Brainerd
that.
was at Jackson Hole.
Powell alluded to that. He said there may be significant further drag in the pipeline. There's a debate about that, TK, to be clear.
Yeah, bolt-on acquisition here. I know a fair amount about this, John. This is pretty cool. This is what you do in academics, and John, you do it in your England. This is a University of Cambridge years ago on protein science. And this is like actually shipping protein stuff to biotechnology labs, researchers, and science. It's ABCAM, ABCAM, and they are taken out this morning by the life sciences juggernaut, Danaher. If you're a hedge fund, John, usually you want to own something in medicine, and one of the popular names is D.H.R. Danaher, I believe, of Washington, which is skewed over the last 5 years towards life sciences. And this is, to me, almost a textbook bolt-on. This teensweens, 1,700 employees.
Danaher buying Abcam, $24 a share.
Yeah.
In cash, that headline drop in just moments ago. Welcome to the program to you all. Equity futures right now on the S&P 500 positive by 0.2%. Coming up at 8:30 Eastern time, Tom, so about 45 minutes from now, 48 minutes from now, we'll catch up with Dana Peterson of the Conference Board going into that payrolls report this Friday.
And that's a pulse of the American economy. I think there's some raging debate here. To me, the key thing here into the end of the month is, in my opinion, the disaggregation of economic data in America. I don't think it's easy for Dana Peterson, or I thought Neil Richardson was just brilliant out at Jackson Hole, and others, and Michael Gapin, and the retiring Ethan Harris at Bank of America.
Legend.
This is really, really difficult to aggregate a fractured America.
So you start to look at really specific things. You can start with hours worked, or you can look at the diffusion of jobs gains, Tom, which is how much breadth is there, how broad are those jobs gains, how isolated are those jobs gains. And Katie, there'll be questions we ask this coming Friday.
Yeah, absolutely. We'll be asking questions about what we're seeing in wages as well, especially as the Fed is looking not just for some slack building in the labor market, but what inflationary impulses are actually coming on the wage side. Another thing we heard consistently out of speakers at Jackson Hole is that they don't see a wage price spiral, but then you see headlines like the UAW asking for a 46% raise, and you maybe start to ask some questions.
Those headlines are important, Katie. I totally agree. Tom, you go into year end and you see headlines like that from UAW. No idea how those negotiations conclude. Let's see if it is those kind of numbers. A lot of people think they won't be, but still, we've seen big gains at UPS, big gains at American Airlines, and Tom, people take notice of those kind of things. They see them, and it influences the way they think about them.
I agree with that, and the barbell of that is the real estate market, which wasn't, it's always a topic in Jackson Hole. I looked at a 4-bedroom in Jackson Hole.
How much was that? Give me the price.
No garage, it was $2.6 million.
2.6 million.
Throw a 7-something rate on that, and
Basic
that's...
2.6 million.
It's a ranch, 1 acre.
You're doing that cash.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000 to put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
We are facing major shifts. I'll mention three for you. One is there's a complete change in the labor market. There's a complete change in the energy future that we are facing. And there is a complete shift in how geopolitical forces organize our economies.
Labour, energy and geopolitics are deeply thoughtful. Christine Lagarde, ECB president, catching up with Tom Keene in Jackson Hole on Friday.
I'm sorry, you wouldn't believe the snark she gets out on Twitter. I mean, boy,
Tons of it,
huge spot of it. They love to go after her. I think she's lovely. She's really unpretentious. She's out there. She's doing the social media, the fandom, the selfies, all of it. She's like a rock star, but she has time. That when Outlaws Tracy Alloway walks by, Lagarde goes, Tracy, I love your cowboy boots.
Oh, that happened.
That happened.
Jackson Hole is kind of bizarre, isn't it?
Yeah.
The people you see, bump into.
I mean, Tracy looks
I had breakfast with my good friend, the South African Central Bank governor.
He's wonderful.
Nice, he's fantastic.
Yeah.
One of my favourites.
Yeah.
He's lovely too.
Yeah.
He's lovely as well. Okay,
But
is that enough
little,
love for central bankers?
Oh, there's like these little, Neil Kashkari shows up with various, children in tow. They were well-mannered.
I didn't see that.
Yeah, they were
to the kids. Very cool. Tom, one frustration that I have with the central bankers, just the way we spoke to the EM central bankers, the South African central bank governor, the question you need to ask those guys right now is what can the Federal Reserve and the ECB and everybody else learn from you? And we touched on that a little bit on Friday, and I think it's a really important question. They smell inflation, they smell it from a mile away, and they act. And they act fast and decisively. And Tom, to some extent, I know we've moved on a little bit, but we still need to look back at the mistakes that were made at the Federal Reserve and elsewhere.
Oh, yeah, and they were down back to emerging markets. Damian Sassar has been great on this. I'm sorry, I see depreciation and devaluation. My first question to the gentleman from South Africa was, what do you do when you get South African Rand at 20? South African Rand, John, is weakened from 14 to 19. I believe that's 5 divided by 14. It's too early in the morning to do that percentage.
Dollar Rand.
It's big.
Yeah, that's
dollar Rand.
Probably not what they want when they've got an inflation issue. But that inflation issue's got better.
Yeah, we'll have to see. Good morning to all of you. Kaylee Lyons is in for not Tracy Alloway, for Lisa Abramowitz. I hear. Are you here for today or the week or
through Thursday?
Through Thursday. Very good. And we are
Tom Solo Friday, going into the long weekend stateside. You'll have fun, Tom. It's payrolls.
Yeah.
It's a good day.
How fun.
It's a good day to be at
You're
work.
going to be in flip-flops, on some beach
I don't do
somewhere.
flip-flops. Not really my thing. Not really.
Saving the show right now with Eurasia Group.
We can
This
discuss
is
that
off
if you
of
want, no?
Ian Bremmer's spectacular AI article in Foreign Affairs magazine with China and their corporate affairs Eurasia Group. Anna Ashton joins us this morning. Anna, what do you think of the Chinese coverage? It's a cottage industry right now for people like you. There's like 5 articles a day I feel like I have to read. What am I missing? What do you see in your China analysis that's not in the zeitgeist right now?
So, I wish there were only 5 articles a day that I had to read.
because it definitely has become something of a cottage industry. I think that the interesting thing that's happening right now really is this détente that the Biden administration and Chinese leadership have been pursuing for the entirety of the summer. And I know that that's not new, and it is something that people have had every reason to see. But I think, the fact that it's being carried out by the Biden administration at this time, when we're headed into a presidential election year, and I really had expected a couple of years ago that by now there would be nothing but competition to be the most hawkish on China. It's very interesting to see the Biden administration deciding that stability is the course it wants to chart.
Anna, this week, key for Secretary Raimondo. What would you expect from 4 days of meetings from the Commerce Secretary?
I think that this is the most important visit we've had so far from a member of the administration because she oversees export controls, and export controls are the things, among others, but a mainstay of the tech policies that the United States has rolled out in recent years that China is most bothered by, feels that this is an effort to contain their technological advancement and even likely to undermine their economic prosperity. So they're pretty upset about the export controls and about things like the executive order on outbound investment that also constrains U.S. abilities to invest in certain sectors in China, including AI, quantum, and semiconductor chips. And now they're getting to speak with the woman who is overseeing all of that. She's already said on the ground that national security concerns are non-negotiable, but she's emphasized that that's just 1% of the U.S. economy. And she's really pushed for a more robust and more stable commercial relationship. And she's gotten some receptivity from her counterparts.
Yeah, we've heard that they're going to be talking. There's going to be an export group meeting tomorrow on August 29th. To your point, Anna, we've heard from her and continuously from administration officials that this is about protecting national security interests. It is not about holding China back economically. But can you really have one without the other? Isn't protecting national security interests to at least a certain degree going to hit China economically by default?
Yes, by default, it absolutely will, Kaylee. And, the reality is that these export controls, starting last October with the ones that Jake Sullivan announced, they're really quite restrictive. They don't just prevent China from buying things that are state of the art. They prevent China from buying anything in the future that is smaller than what these restrictions have set down, and smaller being more state of the art. So they're kind of trying to hold China at a certain place in its technological development.
And all of this is about fancy technology stuff. But the fact is, in my house still, like 80% of the garbage that comes in the door in cardboard boxes says made in China. Has there been any lessening of all the stuff we buy that's made in China that's not going to be in a balloon over Wyoming?
This is an interesting question because of the recent numbers. So the numbers for all of 2022 showed that trade was at an all-time high, over $700 billion. But recent numbers have indicated that exports from China into the United States specifically have dropped by 25% so far this year. The biggest drop in a very long time.
But what was that? I don't mean to interrupt, but this is important, Anna. What was the drop due to? Was it electric vehicles from China, or was it, the coasters? We just had to get coasters, John, for the deck. The gin and tonic was slipping off the coaster.
Where are we going with this?
Anna, what caused that drop in Chinese exports to America?
So there's lots of speculation about that, but I think that it really is likely that it is a sign of U.S. companies beginning to diversify their supply chains. And so more of the inputs for the goods that they are bringing into the United States are made in places other than China. That doesn't mean that they're leaving China. It just means that for the business that involves manufacturing to export to the United States, more and more of them are doing that elsewhere.
So, Anna, is it going through India, Vietnam? Where were you seeing that show up?
A combination of those and other places. But, the reality is that there are no markets that can just absorb all of the export or all of the manufacturing that is done in China for the U.S. market. So at a certain point, probably in the near future, these other markets are going to hit capacity. And then it'll be much more difficult and more expensive for companies to figure out where to go.
And out of interest, who do you think's got the best strategy in how to handle that, to move your manufacturing base out of China without isolating the Chinese consumer?
Well, I'm gonna avoid naming any companies,
Sure.
but I think the strategies that are really focused on in China for China, and ramping up the manufacturing and development that's going on for the Chinese market are good strategies. They don't check every box for the Chinese government or in terms of risk management, but they check the most boxes.
What a change. Anna Ashton of Eurasia Group. Anna, thank you. Just a monster change, Tom. In China for China. In China for China, and then maybe a base elsewhere for the rest of the world.
It has to do around Jackson Hole, where we read a lot of like international relations think tank stuff. I know, John, you're doing the same thing. But what you address there, where there is exactly the point, the touch point for every single article. So they make something in Vietnam, and some of it is basically made in China. They put a label on it, made in Vietnam, and shift it to us. Some of it is stuff from China actually manufactured in Vietnam, and then they ship it to us. And there's a real ambiguity that's really gray, amorphous.
That was on the edge of serious. Do you want to tell us more about those coasters?
No,
Did you get any?
You can't have coasters with fancy crystal that slip. It's like dangerous.
Got it. You need something sticky
Bill
at the
gets
bottom.
up and wants to know the
course.
line.
Wants to have some of the gin and tonic.
Yeah.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
prepared to raise rates further if appropriate and intend to hold policy at a restrictive level.
With the exception of the inflation target, which he said is 2% and will remain 2%, everything else is uncertain.
At this point, we really need to see inflation moving down. And we're seeing early signs of that.
Who knows what GDP is in real time? Follow the labor market.
The fragmentation is something that is much talked about, but that we are now beginning to see.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Monday of a slow, boring August week. No, it's going to be a most interesting week, starting with the fact Bramo is off. Unsure where she is. Somewhere in a latitude north of 55 degrees. I think joining us from Washington, Kaylee Lines joins us this morning, and we are thrilled. Good to have you here.
Yeah,
Thursday.
It's nice to be here.
You know, you'll be here through Thursday, and that's a good...
Say it and mean it, Kaylee. Say it and mean it.
No, did that not sound like I said it with conviction? I'm very happy to see you guys.
She's very happy.
Yeah, very happy. We're happy. I'm happy. Bramo's happy. Anyways, John, what Lagarde said there in the opening comments about fragmentation, that was the zeitgeist to have on Friday. Georgieva of the IMF, Lagarde of the ECB, and both of them talking about fragmentation. How about the fragmentation of the market to begin with?
And to hear from Chairman Powell as well, the reviews of that speech from the Federal Reserve Chairman, all kinds of words, balanced, the word from Renaissance Macro. Tom, neutral.
Neutral.
Tom, neutral.
Neutral.
Balanced, patience, no surprises, Mike Ferroli over at JP Morgan. When you go through the body of that speech, there is something for absolutely everybody.
Yeah.
If you want a hawkish Federal Reserve, how about this? Growth could warrant further tightening of monetary policy. On the labour market, evidence that the tightness in the labour market is no longer easing could also call for a monetary policy response. Just a touch, a sprinkle of hawkishness there. Tom, in the conclusion, though, that patience, that balance, that neutral posture comes to the surface. Absolutely. Navigating stars under cloudy skies, the risk management position of maybe going more slowly, just alluding to all of that, Tom, in that speech.
And there it was, and to me it was a lot of central bankers and fancy people in Jackson Hole trying to deal with an America that perceives it's flat on their back. Kayla, you fly in, and on the short taxiway to the 5-gate Jackson Hole Airport at JAC, you go by not 70, but I'll say 25, 30, 40 Gulfstreams. And the private elite got the planes lined up like at Davos, not at attending the meeting. This is just the prosperity of Jackson Hole as well. And it really goes to the two Americas that are out there.
Yeah, absolutely. When you have that kind of wealth on the one hand, and on the other hand, you have, while we have seen inflation going down, still the average American feeling it in their wallets. Prices may not be going up at the same pace, but that still means they are going higher. They certainly aren't coming down. You're seeing a reacceleration in prices at the pump. All of that pinches the U.S. consumer. And while we're still seeing resilience in the economic data, it becomes a question of when more deterioration perhaps will kick in.
And John, I take real issue with the inflation economics guys that are looking month to month, quarter to quarter, including the important data. This week, I learned a lot at the Pioneer Grill with Joe Weisenthal and Tracy Alloway. Did you see their entourage of digital people that travels with them?
I know.
It's like 7 people.
They've got more producers than us.
Producers.
For the Odd Lots podcast. I noticed that. I noticed that.
And
they're very well dressed too. They go around in suits and stuff. It's quite official.
With the John Farrow look.
I wasn't in the John Farrow look on my day off.
He was very cash.
Whatever that look is meant to be.
It's a hell of an endorsement from Montclair. And John, I look at the inflation at the Pioneer Grill, and that's what America's feeling. They don't care about this economic mumbo jumbo. They're looking at chip beef on toast up $3 at the Pioneer Grill.
I was told I looked like a preacher in my sweater over my shirt. I look like a priest, apparently, on Friday. Won't be doing that again. Tom, there seems to be a difference between what companies are saying. Think the US retailers over the last couple of weeks, Walmart, Target, Dollar General, Dick's Sporting Goods, Foot Locker, and what we're seeing in the hard data. What was interesting to me to hear from Patrick Harker at the Philadelphia Fed go through why he thinks we should pause here and point again and again and again to anecdotal evidence, what companies are telling him in his district.
Right.
I think that's so crucial, Tom, as they go into the FOMC next month. How many Fed presidents do the same thing?
Yeah, and each district is different. Kansas City has a completely different agrarian history compared to Harker's Philadelphia, which is lots of mid-sized business, not small businesses, like, 10, 20 employees, but, 2,000, 3,000, 5,000 employees. That's the heart of the Pennsylvania, New Jersey district.
You could sense a worry, Tom, from those businesses, according to him, that this Fed maybe's gone too far.
Right.
That they're already at a level that is restrictive. And again, I'm going to be interested to see how that debate actually unfolds. The difference between Fed presidents who might start pushing back in certain districts like the Philadelphia Fed and what's happening on the Board of Governors down in Washington.
Kaylee, what do you see in Washington, the politics here? Is Powell a political debate, or is that it moved on beyond that?
Oh, he absolutely is. The chairman has been political, I would argue, for his entire term. But you're starting to hear the conversation more about his future. As we're in the middle of a 2024 election cycle, you have a number of potential Republican nominees, those competing for the Republican ticket. Mike Pence, Donald Trump, others suggesting they would not reappoint this chairman. To use the former president Donald Trump's words, he's been too late, is what he said. That's the accusation on multiple occasions.
That's a guy with a transitory golf game. As he
when he said that to Tucker Carlson,
Yeah.
I did sit there and think, is he talking about meetings? As in, like, does he turn up to meetings with the president? Like, I didn't know where that was going.
Oh, John.
I know what he meant once he completed the sentence, of course.
Very quickly on the data, John, 15.99 shows a resilient equity market this end of August.
Equities near session highs, up by a third of 1%, a little more than a quarter of 1% on the S&P 500. Yields come in at the long end down about a basis point or so to 422. At the front end, still elevated by a single basis point, just shy of cycle highs, Tom, on a 2-year yield.
Coming into O'Hare on Air Scott Kirby here. We're going over Michigan, and you look down and you tear up. It's Wrigley Field, and, it's like the Cubby land and all that. I said, book somebody from Chicago. Katie Nixon joins us now, CIO at Northern Trust Wealth Management. Great seats for the Cubbies, just north of the $1 million, the Golden Mile, whatever they call it out there. Katie, how golden is the American economy right now? Do you really buy economic slowdown?
Hi, Tom. Thanks for having me this morning. I think, as Chair Powell said, we're growing above trend. We're certainly seeing surprising resilience in many, many areas, and the resilience may continue. And I think that was part of the cloudy skies comment that Powell made. The ability to really accurately forecast going forward has been really impeded by some of the particular nuances of this post-COVID recovery. As many of you guys have noted, it's all going to come down to the labor markets, and there we also continue to see just abnormal strength given the amount of monetary policy tightening that we've seen. So we'll absolutely see on Friday what happens, but we continue to see strong and tight jobs markets.
Okay, so we're seeing strength, we're seeing resilience, as you say, despite the incredible pace of tightening that we have already seen, Katie, and that is what is contributing to this higher for longer narrative that theoretically, there's not going to be any reason to bring rates down from the high level at which they sit now if you aren't actually seeing them transmit into the economy. How do you position for a higher for longer world?
Well, Kaylee, thanks for the question, and I think we're there. We certainly see high rates across the curve. We've seen a dramatic re-rating in the long end of the curve in the last couple of weeks, acknowledging two things. Firstly, that the economy is not going into a recession, so the soft landing, no landing scenario has really taken hold. But then, as you note, it's the for longer part of the monetary policy that I think more and more investors have gotten on board with. So I think we're already there in terms of seeing how high rates can go. We see positive real rates across the curve right now, and that's also something that Powell mentioned and noted in his speech. So we think that the economy is strong, rates are going to stay high, and that's certainly going to be good for bond investors.
We're far along in the adjustment process, maybe in the bond market, and that's what you cited, Katie, but can you say the same thing about the stock market?
John, again, good question. So here's the problem. There are sort of many dimensions to the headwinds for equities right now, for U.S. equities in particular. One we've talked about, and that is the monetary policy higher for longer mantra. Higher, longer term rates are going to be a headwind to valuations, and valuations are already very high, stretched relative to historical norms and averages. The second thing is inflation, which is going to be persistently higher, which is why the Fed's going to remain higher. And inflation has been something that's been a friend to corporations over the last couple of years, as they've been able to really easily pass those price increases on to consumers, and as as growth has been, nominal growth has been really strong. We're seeing now more of a difficulty in passing those prices on. The last thing I'll say is, it's a global economy. Stocks are global, and we are seeing a slowdown outside the U.S., China and Europe in particular.
Hey, Katie, the Northern Trust Company is as venerable and cautious and measured as there can be. What are you hearing from your clients, high net worth people? I'm going to suggest they've participated for the good the last decade. Do they have an enthusiasm out 3 years? Dare I say out 5 years?
Tom, thank you for the compliments about Northern Trust, and I couldn't agree more. And one of the great things about Northern is that we work with our clients as investors, but many of them are business owners. And so I think because of their front row seat in the economy, I think there's a natural, caution right now. Everybody's waiting for those long and variable legs to take hold and to pull down economic growth. And you marry that with equity markets that have been incredibly buoyant this year. And I would suggest that most of our clients are just cautious right now. And the other side of that is they can get very high returns in cash, short, and even longer duration fixed income now. So we're seeing a rebalancing in portfolios away from risk and more towards locking in goals, locking in funding of goals with these high short-term interest rates. 5%
on a 2-year. Katie Nixon, thank you, of Northern Trust Wealth Management. 5.1%, just short of that at the moment. 5.08%, yields higher by about a half a basis point on a 2-year. On a 10-year, Tom, down about 2 basis points. Let's call this 422 on a 10-year maturity.
It's great to talk to her. Talk about Chicago. We don't go out there enough, John. I think I hate to drive in from O'Hare downtown.
What's bad about it?
It's like Narita. It takes forever. It's never pleasant.
Like JFK into
Manhattan. We got to get a helicopter, but we need to bring the show out there. I had family way back that was venerable there and all that. They'd go to Daly's restaurant, the whole steak thing.
Does that make them fancy?
It makes them fancy. Yeah, they're like fancy people from there. And it was just great to talk to Katie. And we forget about the place of Chicago in our financial history.
We can head over to Chicago.
Yeah,
I just got back from Jackson.
Catch up with the Chicago Fed
Well,
president.
we're busy.
Katie, the whole point of this program sometimes is just to establish where we're going next.
Yeah, London.
Just set out the
London.
London, September. Yeah. Tom often features this around a bar that he might want to go to or a football match in our future.
Well, the problem is, John, the bar that I go to, everyone is an Arsenal fan.
North London Derby, September.
I know.
That happen.
But, Nick and the team at the Langford Cigar Bar, they're all Arsenal all the time.
Get Nick to sort out tickets.
I am.
If you're just tuning in, welcome. Please stick with us. Equity futures on the S&P 500 positive by 0.3%. I feel like that's an everyday occurrence, Tom. Please stick with us. I'm so sorry.
Please stick with us.
So sorry.
Okay, let's go to this. Harry Kane, 2 goals at Bayern. It's starting strong here.
He's getting it done, isn't he?
Got a penalty
it's great
shot.
To see.
Even did a great video. I'd really never heard the guy talk because the tots kept him so removed for whatever reason. And he's like making an effort at Bayern to say, hey, I'm here.
Sometimes, Tom, when you're the man, there's a burden that comes with that. There's a lot of pressure. I get the sense, just seeing from him play over at Bayern, that he's just playing a little bit more freely.
Is that how you say it?
There's less pressure on him.
Yeah. Are the tots winning too? Are they playing better because they don't have
I don't
Mr.
know.
Kane?
It's such early days. I wouldn't go that far.
Yeah.
I don't know. But they look good. I watched a little bit of them over the weekend. James Maddison looks like a great signing.
I saw him, tots. He was with Lester, however you pronounce it.
Lester, yeah, that's the one.
And he's pretty good.
He's
he really controls it. What's Son going to do? The Korean is spectacular. Has he found a place yet without Harry?
Every time they show the highlight reel of the Premier League and that Son goal is in there, where he opens up his body and drills one into the top right corner.
Right.
I think of you because I know that you were right behind.
We were right there.
Goal. You were right there.
I missed the goal. I was having my meat pie. I was eating it wrong with a knife and fork.
With a knife and fork. And I was so disappointed.
A guy came up to me and said,
Farrell would eat a football game with a knife and fork.
A guy came up to me. He says, oh, my God, you're here. Farrell wouldn't eat the damn pie like that.
No way.
Yeah.
With your hands, Tom.
Oh, I had a knife and
with your hands. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
We have to get inflation down to 2%. We all agree on that. I mean, we're all committed to that. The question is how to get there. We are at a restrictive stance, in my view, and we're putting pressure on the economy to slow inflation. The question is whether we need to increase the pressure or just keep pushing. And I'm in the camp right now, just keep the pressure going, let this work through.
Patrick Harker there, the Philadelphia Fed president, on the effort over at the Federal Reserve and endorsing, to some degree, a pause at the September meeting. Much more on the Federal Reserve still to come, going into payrolls on Friday. The estimate at the moment, 168,000. That progress this Fed is looking to make, they want smaller and smaller numbers in the job market to take some pressure off the inflation story. In the equity market at the moment, we're elevated and near session highs on the S&P 500, up by 1/3%. Yields are lower by a single basis point. Let's call it a single basis point on a 10-year to 4.2256. And at the 2-year level, at the 2-year maturity, yields up by a single basis point. The 2-year right now, 5.09%, Tom, in the Treasury market.
I don't think we talk enough about Patrick Harker. This is the former head of Wharton, the dean of Wharton. This is a guy that ran the University of Delaware, Liz Ann Saunders' alma mater, and I believe a guy named Biden. And what's important here is this guy is an operative and thinking engineer. He really understands manufacturing processes, arguably more than any other Fed official we have.
And you know what? He's also really, really nice.
Yeah.
Can I just say that?
He's a real worker. He's not a PhD kind of academic
Total
guy.
gentleman.
Yeah.
Total gent. Great to catch up.
We talked about Williamsport, Pennsylvania, and Little League, that we should do a remote there, surveillance remote.
Another remote.
That's God's Central Earth, where you go to Williamsport, Pennsylvania.
We can set the tour for the election year, Tom.
Yeah, Ira Jersey can come.
Make that happen.
Let's do that right now. We're going to dive into the bond market here the end of August, an important August week, not a lazy end of summer week at all. We can do this with Ira Jersey, Chief U.S. Interest Rate Strategist at Bloomberg Intelligence. Ira, if we get a yield breakout higher, price down, yield up, 3-month T-bill, I mean, even the old LIBOR OIS, the 10-year yield, the real yield goes back through 2%. What are the ramifications of a price down, yield up move?
Well, I think the way that you get to that really matters. So if we wind up with a bear market more than we've recently had, I think that just shows that the market's thinking that the Fed's going to not make a policy mistake, right? So the big risk now, I think, is that the market starts to price for a Federal Reserve that ultimately hikes another time, maybe even 2. We're not priced for that at all yet. But if you wind up with an environment where you get 170,000 jobs a month for a long period of time, the market will be thinking that the Fed eventually is going to make a policy mistake. We have an important test. I think Mr. Jonathan mentioned just a second ago how busy this week's going to be. At 11:30 today, we have a 2-year auction, and with 2 years above 5% again, up toward 5.10, which is fair value. If you think the Fed's going to hike once and then hold for all of 2024, that'll be really interesting to see if we have decent demand at that auction later this morning.
Bramo's away, so we have to have auction chat with Jersey. I don't know what that's about. Ira, let's go back to Jersey 101. Out the curve, where does the Fed influence rates? They obviously influence 3-month T-bill, 2-year, but how far out do they really influence a curve?
Well, they influence all of it, but insofar as how they influence expectations, right? So the two-year yield is going to be very sensitive to where the Fed funds rate is now, where it's going over the next year or two. Obviously, it should be basically the average of where Fed funds is going to be over the next 2 years. Farther out the curve, it's really, do they set expectations in such a way that that yields are going to be lower because the market thinks that the Fed's going to be cutting. So one of the reasons you've seen this reasonably substantial backup in 5-year yields and 10-year yields, so that belly of the curve is what we like to call it, is largely because we're pricing out interest rate cuts that were priced in earlier in the year, right? So we were pricing at one point for 5 interest rate cuts in 2024. Now we're pricing barely for 2. So you wind up with a situation where the market thinks that interest rates are short-term interest rates are going to remain higher for longer, and because of that, you wind up with a some people are calling it a bear steepening. It's really a bear uninversion, but the yield curve is still inverted, right? You still have 5% 2-year yields and just a little over 4% 10-year yields. So you're not talking about a curve that's steep at all. It's still inverted very significantly.
While we're at it, the rest of the supply time, I'll go through the auction slate. 2-year notes, 5-year notes, 7-year notes tomorrow. $36 billion worth of 7-year notes tomorrow. Ira, can I do the boring stuff? Maybe the juvenile stuff. Can we talk about September the 20th? Ira, just how high is that bar for a hike at the Federal Reserve? We've got a payrolls print on Friday and a CPI report on the 13th of September. How high is that bar?
Yeah, I think it's reasonably high for September, given that they did move in last month. So, yeah, I think that they're on a path to try to go every other month at this point. A pretty smart investor that I talked to said, they were hiking at 75s and then 50s and 25, and now they're hiking in 12.5 basis point increments. And so another 25 basis points in November is not out of the question. But I think that September pause is kind of the base case scenario, unless we wind up getting something absolutely crazy in the data that doesn't seem very likely at this point.
Well, and Ira, we have all been focused so much on will they, won't they hike in September or November, whatever it may be, where ultimately Fed funds is going higher for longer. What about the balance sheet? How should we be thinking about the runoff and its implications at this point?
Yeah, so the runoff is kind of on, what President Harker would say is, like watching paint dry. It's happening and it's already priced into the market. We wound up repricing a lot of the quantitative tightening that we were going to get when it was first considered. I think importantly, and we actually have a note out on the Bloomberg terminal this morning about this, is that the Fed is going to have to stop quantitative tightening at some point for very technical reasons. And basically, it's that banks need a certain amount of reserves to comply with a lot of the Basel capital regulations. And we estimate that that's around $2.5 trillion. So at some time during the first half of next year, reserves are likely to hit that point where the Fed is going to have to stop quantitative tightening. Now, will it increase their balance sheet? Not necessarily, but it just has to stop running off the balance sheet. And we think that that will happen even before the Fed starts to cut, more for technical reasons as opposed to anything that's related to monetary policy. And Ira, when do you think the Fed starts to cut? Yeah, so our view is not until the fourth quarter of 2024, primarily because we think that things will be good enough and that the Fed isn't going to feel compelled to cut very early because you need 2 factors. One, you need inflation to be near their target, and 2, you need to start to see job losses, and we're very far from that right now. Just look at last week's jobless claims numbers. They were fine, and so until you wind up with a period of job losses, not just 1 month, but several months of job losses, the Fed's not even going to consider cutting.
Ira, the important question, were you there Saturday night?
I was actually on a holiday with my daughter, so I wasn't there Saturday night. I did watch part of it, and Lionel Messi is really good. Yeah, Lionel Messi is
the Inter Miami tour.
He came up from Miami.
The road show came to New York, or New Jersey to be more specific, right?
To both of you quickly, I don't want to take away time. Is he like in his prime, past his prime? Ira, is he? How do you judge this Messi of America?
Well, skill-wise, he's as good as he's ever been. I think it's more of, how he's not going to go 90 minutes every game anymore just because of his age. But, when he's on the field and he's fresh and not injured, he's as good or better than he's ever been.
How could the Tots not pick him up? I just don't get it.
I'm not sure. I'm not sure they had the financial backing to attract that kind of move, Tom. It's that time of year where we complain about the price of sporting events. The US Open starts a little bit later. Ira, thank you. Ira Jersey. The price of Ira's vacation, the same price as the ticket on Saturday evening to watch Lionel Messi.
And you bring it over to TV, Paul Sweeney's world. I'll be with Paul on radio here in a bit. And the whole pricing of sports, I don't get. I just don't get it.
Can you imagine World Cup 2026 in the United States? How much those tickets might cost if you don't get them through official channels.
Am I correct that Formula One in Las Vegas coming up is a different pricing than at Monza in Italy?
Yeah.
They're not like equal.
The US sporting events cost an absolute fortune.
Right. David Rosenberg in Toronto publishing moments ago, John, with a bullish bond bias. That to me is the great mystery call out 90 days.
We'll pick up on that note, Tom.
Price up, yield
Megan
down.
Swiber, Bank of America. Thanks for that. Matt Miskin, John Hancock, and Dan Skelly of Morgan Stanley. All of that still to come in the next hour on Bloomberg TV, live from New York City. This is Bloomberg.
And money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
Good morning, everyone. Bloomberg Surveillance. Kaylee Lines in for Lisa Bramwitz. Mr. Farrell preparing for the next hour. of the open and all that. We'll open here. And what I really want to convey right now is this is not a sleepy August week. There's a ton of economic data. It's an early jobs day coming up to. Kaylee, on Friday, I pulled a short straw. Bramo off, Farrell off. I'm working. McKee, are you working on Friday?
There's nothing happening Friday.
There's nothing happening Friday. We got a jobs day on Friday.
You know what's weird is that it is not an early close in the markets for a 3-day holiday weekend, and all the bond traders are kind of upset about that.
Yeah.
Because it's jobs day?
Because it's jobs day.
We hope, Kayla, it's going to be interesting to see what we see out here, but I think it will change the political dialogue, the sum total of what we see of the spirit of America, off ADP, off claims, and what we see off Jobs Day.
Yeah, especially as this is a president who has touted all of the job gains, millions of them he has seen since coming into office. Of course, we were emerging from the pandemic, so that is a contributing factor, but also the unemployment rate at 3.5%, the lowest it's been in decades. That is something this administration has continually tried to tout, but isn't necessarily showing up in economic approval ratings for it.
Across the span of Bloomberg News over the many decades, there are people that have given us leadership. We don't spend enough time on this. His people said to Bloomberg, I need a fancy title. So he's our international economics and blah, blah, blah correspondent. But what Michael McKee is our foundational voice in print and now in media, in radio and television on economics. And he truly led our coverage at Jackson Hole this week. I guess Lagarde was a highlight. There was this highlight, the papers. I thought Barry Eichengreen, it was great. But the real highlight, folks, and for those of you on radio, I can only describe McKee getting me on a saddle. No, not out on some trail, but Michael McKee getting me into the $1 million cowboy bar in Jackson Hole. It was a snapshot. A guy from J.P. Morgan came up to me, a bunch of people that watch us in Missouri, and, all that, Michael McKee. The vibrancy of that economy speaks to a split America.
Well, it's a tourist place where, and tourism has grown tremendously, and a lot of Americans have been traveling domestically because it's expensive to go overseas. So it is very crowded these days, and it's hard to get into the $1 Million Cowboy Bar. I'm sure that you got past the velvet rope because you're a celebrity.
No,
Did you get in because of your cowboy hat?
Yeah, exactly.
Yeah. No, I went to the Gun Barrel Steakhouse, which is legendary there. And, people actually showed up there to meet us. They're so fascinated by what we do every day. And, you should have seen all the stuffed animals and all that.
I should have seen. I wasn't invited this year.
You get your drink and it's got this, like a Winchester stir stick or whatever. What did you learn from this? Not the buoyancy of Jackson Hole, but the grind of all these seminars that you've seen. What was distinctive this time?
I think the takeaway is that right now is a very uncertain period, and because they get asked about it, various Fed officials and ECB officials, a lot of ECB officials there, they are telling people what they think right now, but also cautioning everybody, we don't know that's the way we're going to vote because we don't know what the data are going to tell us. And so the short-term takeaway is that it's hard to know exactly what to do now. And the medium term to longer was interesting. That was the theme of the conference, that there's going to be a lot of changes in the economic world over the next decade, and it'll make it more difficult in some ways for central bankers, but it's going to be different. We're going to have it'd be when Kaylee is our age, the issues are going to be quite different than they are now. Trade is changing, and housing is changing, and so much.
When Kaylee's our age, the glaciers will have finally pulled back. Kaylee, pick it up.
Okay, well, looking at not so much the longer term, just in the course of the next week, you said the data is going to be important. We get JOLTS, PCE, jobs on Friday. How instructive is it going to be for a Federal Reserve that is trying to make a decision in just a couple weeks as to whether or not it is going to leave rates on hold or hike again?
Well, PCE is going to be very important because that's the number that they follow, and even though they target the headline rate, they are following the core rate. So we will be watching to see what the monthly change in the core rate of PCE is, because at this point, you're going to have base effects in the year-over-year numbers, but do we see the core rate go down on a month-over-month basis? That's what they're looking for, and that'd probably be more important than jobs. Jobs is going to be a confirming piece of data that if it slows down as expected, that they're on the right track.
Very quickly, I want to get to this, but this is a vignette. There's this bear, folks. It's like 12 feet tall. It's like frightening how big this bear is. And you go through these wooden doors and only Michael McKee can go. They won't let me into the room. Saturday, what a vignette. Barry Eichengreen on debt and our high debt. And the discussant was the wonderful Carmen Reinhardt, and you were in that room. Just give us a window into what the room's like when you've got a giant of international economics like Eichengreen, and with all her work at the World Bank, et cetera, Carmen Reinhardt as well.
Oh, it's fascinating because you have an audience of giants in the economic world, academics, central bankers, and so, I mean, if it were me, I'd be nervous to present
Did
to all
Carmen
those
start
people.
yelling?
Carmen did not start yelling. She generally agreed with Barry, but that was the most interesting paper in the sense that Eichengreen presented the idea that growing debt is going to be impossible to sustain, but there is absolutely nothing that will be done about it because the political will isn't there. And man, the people in the audience were so disappointed. There was one person who said, I'm going to have to watch TV comedies all weekend to get over this.
Well, that's a caution of Eichengreen, and when he talks, people listen, as he did with us here on Friday. Michael McKee leading our coverage at Jackson Hole. I segued from that because I wanted to talk about debt right now with Dana Peterson, chief economist at Conference Board. The Conference Board hugely aware of the consumer and the business tone that's out there in America. Along that line, and to take it from the academics, Dana, are we over-debted right now? Are we up to our eyeballs in credit debt?
Absolutely. Certainly when we look at the consumer, credit debt has risen to where we were pre-pandemic. Delinquencies are up. When we look at the sovereign debt in the U.S., it's extremely elevated. Interest rates are rising, and that's causing debt service to rise as well. And we're concerned about both the sovereign situation as well as consumers heading into a season when they're going to run out of excess savings and also may be laden with student debt loan repayments.
Well, to that exact point, Dana, we've been talking a lot about the month of September. I am interested in October when those payments resume after years of being on pause due to the pandemic. What economic impact is that likely to have, given how this could be a very large factor in household budgets?
Well, it's probably going to take several tenths off of GDP growth in October, and it's going to weigh on the outlook going forward, because certainly if people were using credit cards to finance their debt and they were also taking that reprieve from student loan payments, when all those things come due, they're not going to spend, and they're probably going to start fearing for the economy in general because their own personal finances will not be as robust as they were.
Are we starting to see consumer behavior change already in anticipation of that? Dana, what evidence might you be seeing of that?
Well, not really. We think consumers are still looking at the fact that many of them are still working. They're still spending on services, even though they're saying that the types of services they're going to spend on will be more towards needs rather than wants. But the point is that they still anticipate that they're going to be spending, and they're not really looking forward to the fact that, yes, they're going to have higher debts, their balance sheets are not going to be as healthy, and certainly interest rates are going to be very elevated in case they have any emergencies where they might need to finance something. So I think consumers are not really focused that much on the future as much as they should be.
Dana, you're expert at this. The theme at Jackson Hole, and particularly our day with Managing Director Georgieva of the IMF and with Lagarde of the ECB, they both brought up fragmentation. How fragmented is America right now? How disaggregated are we in our economics?
Well, I mean, you do have very different responses to what's going on in the economy. Even when we look at our own consumer confidence measure, you get different readings by age and by income. And so we do think there is quite a bit of fragmentation in the economy right now.
Well, the fragmentation that's there, I guess we see it in a jobs report on Friday. A lot of people are waiting for, I'll say, sub 100,000 non-farm payrolls. How disaggregated is that number? I mean, it's 150 million for conversation, but is part of that 150 million flat on their back and the other part confident?
Well, I think it really depends on what industry you're in. Certainly the industries where you have to show up to work are still hiring, but the industries that were former pandemic darlings like tech and finance, even transportation and warehousing, they're seeing job losses and weakness. And even with the big revisions that we saw in the payrolls data dating back from March to 12 months prior, we saw that that there were entire gains wiped out. And so if you're in those sectors, you're probably not as ebullient as if you are in, say, hotels or restaurants or even healthcare, where there's still quite a bit of hiring going on.
And finally, Dana, can I ask you about the housing market and the mortgage rates that people are facing if they're trying to buy a home or contending with it? They're thinking about selling the home that they're in, that they have a lower rate on. How is that a factor in the perception of the economic health of the country that consumers feel? If they're looking at home affordability that is the worst it's been in decades, rents that also are incredibly high.
Well, it's interesting. You actually see bifurcation in the housing market. Existing home sales are down in the dumps and prices are falling year on year because mortgage rates are so high. Why would you move if you're going to have a higher mortgage rate than what you have now after you probably refinanced a couple of times during the pandemic? But then with new housing, we're starting to see a little bit of a pickup because you can't get an existing home. But all in all, affordability is certainly down because interest rates are so high. And also in certain markets, prices are still rising year on year because this is very much about location.
Dana, thank you so much. Dana Peterson, the conference board, with us this morning. Kaylee Lyons and Tom Keene with you here on Bloomberg Radio, Bloomberg Television. We're staggering into the week as well. I want you to dovetail your Washington view here. You planted up here. You're now planted down in Washington. My basic take is the history is Washington sleepy in the summer, and I just don't get that this year.
No. I was told August would be a chill month, Tom. That was what I was promised when I moved down to D.C. What I got instead was multiple indictments of a former president.
Right.
Natural disasters that the president has had to make trips to go visit, a lot of conversation about a number of policy matters, including potentially a government shutdown that could be on the horizon this fall. It has been anything but sleepy, and a lot of it is informed by the economic reality that the American people are facing right now. That's factoring into electoral politics when it comes into the 2024 race, and for the Biden administration, of course, as well, out on the road touting Bidenomics.
We're informed by Green on the Screen. Futures up 20, a nice lift off of that solid Friday lift. Dow up, futures up, additional 165. The VIX under 16 is my lead equity number, 15.83. SPX up 0.5% this morning. To all of you, we welcome again here as we start the week out on a Monday. It's a little tentative. Right now, what it is back to school, and we are thrilled that Kaylee Lyons is with us as well. Kaylee, I want to talk to you about a huge deal for parents, and that is the kids they have. You were an acclaimed dancer in school at UVA as well. All sorts of national cred here is well. How do you do dance in college? How do you actually pull that off?
The important conversations for a Monday morning.
It's brutal. I mean, isn't it? The physical part of it is like a sport.
Yeah, maybe not as demanding as NCAA athletics, but certainly. And I'm not in as great shape now as I was then.
But, you know, you're doing it, and you're acclaimed in that. And I think of all the parents out there doing this with kids, boys and girls, right now. And it's that time of year where you got to figure out what to do in the fall. And it's just like a sport, isn't it? I mean, you know, you're doing it 365 days of the year.
Yeah, well, whatever you need to do to pad that resume for college applications.
Is that how you did it? There we go. There would be none of the padding of resume here the last week of August towards college. I would never want to hear from that as well. This is the strangest of August weeks. I really can't say enough about it. To that jobs report on Friday, and we'll have that for you. Kaylee Lyons with us the entire week. That is a good thing. The futures up 20. Stay with us through the day on Bloomberg Television and Bloomberg Radio.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
how do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
If there was a big strike that affected multiple auto manufacturers and lasted for a long time, my fear is that would have a pretty material impact on the manufacturing economy. So that's where my head is. About wages, as I highlight, as we've just described, I think wages move slower than prices.
Austin Goolsbee of Chicago, somewhat controversial, replacing Charles Evans out at Chicago, and been a great supporter of the program for years. So it's good to see Austin Goolsbee out in Jackson Hole, he of the University of Chicago. Right now, let me try a little bit of a market check here. Futures up 19, the VIX under 16. The surprise lift to the market on Friday, 15.86. Coming in from a 17 level, it's sort of midterm here in the very difficult August challenges that we've had. The yield, well, they come back a little bit, 5.06% on the two-year yield. I mean, still having trouble with those levels. How unusual, 4.20%. Brent, we haven't mentioned today, $84.45. Oil in betweeny as well. Gold, $19.44 the ounce. Dollar still giving us some love here. Strong dollar with DXY over 104. And euro 108.10 away from the 107 level, a little bit stronger euro today. Of note here with all the economic data will be the movers of a quiet summer week. I don't buy it for a minute. Kaylee Lines in for Lisa Bramowitz, moving the stocks this morning. What do you have?
Well, there's a big one in Hawaiian Electric. Remember, this company has been hammered in recent weeks, given the role it was in theoretically could have played in the wildfires we saw in Maui. Concern about potential liability that this company had. So the stock was down 72% from August 8th when that fire happened to the close on Friday. This morning, though, up 37% after the company that owns the utility put out a statement saying its power lines had been de-energized hours before that wildfire that killed at least 115 people. So a little bit of relief maybe in the stock amidst obviously the horror that is still there on the Hawaiian island. Tom.
No jokes here. This is still an ongoing tragedy of immense size. I honestly think the X number of time zones to Honolulu has a lot to do with this, that it's a little off our radar because it's so far out to the west across the Pacific Ocean. But you've got to believe not only the litigation to follow of all this damage and tragedy, but also just the sheer process of rebuilding, which we're not to yet, but you really wonder where that's going to be as well. What else do you have?
Well, in other news, 3M also is a mover that is higher. This is on reports of a settlement of $5.5 billion that Bloomberg is reporting the company has tentatively agreed to resolve more than 30,000 lawsuits, speaking of litigation, Tom, that were claiming it sold the U.S. military defective earplugs for combat. But that $5.5 billion settlement amount is actually smaller than what many had thought. So you're seeing a little relief in the shares this morning, up the better part of 6% in pre-market trading. And then I wanted to point to Alibaba as well, really just any Chinese ADR that you could look at this morning. We talked a lot about how overnight, Tom, we saw a litany of measures coming from China to try and shore up Chinese stocks. Initially, it worked really well, up 5.5% at the open in China. Saw that really fade, though, only closed 1.2% higher. Alibaba this morning up by about 1.7%.
I'm going to link that into renminbi. This is a weaker renminbi, 7.29 yuan. Let me get that up. You can do that on the Bloomberg terminal, folks. USD, CNY. The foreign exchange power of the terminal is breathtaking. I take it out to 2 standard deviations. Kaylee, we're not there. 2 standard deviations on yuan right now is 7.34. So we're a little bit distant from a weak renminbi, weak yuan, I should say, move there as well. Continue to watch us. Stephen Engel with so much of our good coverage with Yvonne Mann over in Hong Kong. Look for that in the evening hours. Right now in the evening hours in Detroit, the UAW with strike approval needs to figure out what to do. Following this is somebody encyclopedic on Detroit, on Dearborn. David Welch joins us, Bloomberg Detroit Bureau Chief. David, how close are we to a strike?
Look, I think we'll have one with at least one of the companies. The strike vote itself, this always happens. And the workers always vote for it because that's what gives negotiators the leverage to negotiate a deal. And it's sort of a legal requirement that they do it. So, I don't want us to get carried away that this vote, even though it was a landslide, it always is, means they're going to walk out in the next couple of weeks. But we do have a midnight September 14th deadline. We've got a union president who has big demands. And we have companies that they know they're going to have to pay these guys something because they've gotten very, very cheap contracts over the last decade and a half, really. But how rich is the question?
David, an average SUV, car, truck takes 17 to 18 hours to build. So these guys are going to build less than 2 cars a week?
Not sure you understand the math. They build multiple cars per hour.
Well, but we're going to get down to a 32-hour work week. I mean, come on. I mean, David, I know you're clocking in a 32-hour work week, but most of America isn't here. How is the United Auto Workers going to get a 32-hour work week?
That's one of those. So look, the whole thing, how this is unfolded, is interesting. Weeks ago, the UAW president, Sean Fain, and the vice presidents who actually lead negotiating with each of the 3 car companies laid out their goals for bargaining. And the 32-hour work week and the bringing back defined benefit pensions wasn't there. What Fain did is he took a list of demands from the membership who emailed them to him or whatever, and that was included in there. Something like a 32-hour work week to me is kind of like the guy who runs for student council and promises the high school students they're going to have draft beer in the cafeteria.
Aspirational.
I just big pay raises, better pay for battery workers. I think all those things are realistic and on the table, and I think the car companies know they're going to have to do something.
And Kaylee, it's a really important. One of their demands is also to get the Detroit Tigers over 500 baseball. Once again, they failed to do that this year.
Aspirations abound. But David, this isn't just about the actual wage number, that whatever raise comes out of this or whatever agreement related to pensions or the hourly work week, et cetera. It also more fundamentally is about the EV transition and what's going to happen to workers in that. Can you walk us through that, David?
Yeah, the first part of it is what you pay battery workers, because General Motors has a joint venture in Ohio. It's the only unionized battery plant in the country right now. And the starting wage is $15.50. They just cut with an interim deal to raise that by $3 or $4. So now most of the workers are making right around 20 or a little more if they've been there for the whole year the plant's been open. But that's still well below the $32 an hour that assembly workers make. And the union wants to get that pay raise up. And then, these plants, these battery plants and electric motor plants that the companies don't own are going to replace workers who make engines and transmissions and exhaust systems.
David,
so it'll be about organizing those people too.
David, help me here. Have we stopped buying EVs? Like everybody that wants an EV has gone out and bought an EV and that's it?
No, but growth has definitely slowed down. I think we are reaching a point where the early adopters And really, these have taken over the luxury market in a number of areas. So, look, there are only so many, people out there who can buy a $60,000, $80,000, $100,000 EV. That's why Tesla's been dropping prices, and that's why you've seen others drop prices too. So there's growth out there, but even with the price decreases from some companies, including Tesla, they're still not cheap vehicles.
David, thank you so much. Terrific brief, great knowledge. David Welch, he's our Detroit bureau chief, which barely describes his contribution to what's going with automaking, particularly down the interstate of the Midwest of this nation. Kaylee, your observation on a Monday as we stagger through a really important week.
Well, I'm watching, Tom, to see if we can actually hold the gains we are seeing in the future session today, because we have yet to see two back-to-back gains for the S&P 500 in the month of August. We only have a few trading sessions left in this month. If we don't get the back-to-back gains, that'll be the first month we've been lacking that since 2002. It just goes to show you how an equity market that ran really far up until this month is starting to face more challenges.
Yeah, I have trouble with this. I mean, we could go back to Sam Stovall at the beginning of the show and this idea of, with equities, and it's different for each asset class, but 10% correction, 18%, maybe 20% bear market. And then the idea that every once in a while things get ugly down, you go say 35%. We've barely nudged towards a sense of correction, and yet everybody in the Bart Simpson School of Strategy is having a cow. I mean, that's where we are.
Are you saying I'm having a cow, Tom?
No,
I was just pointing out my stat of the day.
Well, it's very good. It's a very good stat of the day. Can you come back tomorrow?
I'd like to. Okay. Will you have me?
Well, we'll have you if we can't figure out where Bramo is. She was with us at Jackson Hole.
She rode off on a horse somewhere.
No, she went off on a Gulfstream. I don't know what that was about. We will be here through the week. Jobs Day on Friday. This is Bloomberg Surveillance. Good morning.
On the next episode of The Circuit.
And I've heard you say you were really motivated by the fact that a lot of people didn't think you could do this.
I think even today I'm underestimated. And I think even today Bumble is underestimated in terms of what we can be and what we can do in the world.
Watch The Circuit now on Fire TV channels.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Let's get your trading week started. Live from New York City this morning. Good morning, good morning. Your equity market session highs and up 0.5% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, officials stress the need to keep rates high for longer. China struggles to put a floor under the stock market, and auto workers are putting Detroit on notice. We begin with the big issue, payrolls, up next.
Follow the labor market. We're watching the labor market. The labor market has stayed tight, remained incredibly tight. We have so many good, solid labor market metrics.
We're still at record lows in unemployment.
It's still solid, but it's slowing.
It's solid, but it's fragmented.
We've seen a bit better, that kind of cooling off dynamic in the labor market data.
We should continue to see some of that softness show up.
What we've seen is a lot of nominal wage growth because of high inflation.
Real wages are positive.
You want real wages to grow. You don't want nominal wages to grow.
The big question is, do wages follow inflation or do wages cause inflation?
Well, the persistence and strength of wage growth built by an undercurrent of productivity continue.
Monetary policy will continue to be data dependent.
He's going to wait to see what the jobs report is.
Joining us now to discuss Bank of America's Megan Swiber, John Hancock's Matt Miskin. Megan, first to you. This Friday, payrolls, September 13th CPI. Just how high is that bar now for a hike in September?
Yeah, John, so we are not calling for a rate hike in September. We think that the balance of risks really tilts them at this point to hiking in November. And a big part of that is because we've seen a lot of good progress on the inflation landscape so far. And as was mentioned in the lead-in, the big question right now is how long is the Fed going to hold at this higher for longer policy stance? And above consensus payrolls would certainly point to a very strong labor market that's skewing that distribution of risks to just higher inflation in the future.
Matt, do you think we've made enough progress to hit pause on September 20th?
It looks good until it doesn't, John. And right now, we think we're in a place where the U.S. economy is on thin ice. And frankly, the global economy is on thin ice. And usually at late cycle environments, it's not higher for longer. It's higher until something breaks. When there's a liquidity event, where there's like where the regional banks were in March. But right now, yields are back where they were. We've kind of faced our fears in equities right now where higher dollar doesn't seem to matter. Higher interest rates don't seem to matter. But at the end of the day, these things do matter, and they are likely to weigh on growth, and it's going to look good until it isn't. And then that's actually going to cause a pretty big reversal in our view on this outlook on Fed policy. And that is likely to change as we get into 2024.
Equities positive right now by 0.5%. To Matt's point, SocGen's Kick Juice publishing just moments ago. Here's the quote. I'll reread this a little bit later in the program. Both Christine Lagarde and Jay Powell made it clear at Jackson Hole that they intend to see the fight against inflation. There will be no changing of targets and no premature easing. But the earworm that I can't keep out is Mike Tyson's "Everyone has a plan till they get punched in the mouth." And the headline of this piece this morning: unless China punches us in the face, everything will be fine. I'll pick up on that a little bit later. Chairman Powell at Jackson Hole, the message was pretty clear: higher for longer.
We see the current stance of policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective. 2% is and will remain our inflation target.
Mike McKee, they're navigating the stars under cloudy skies.
Yeah, that was a reference to 2018 speech during which Jay Powell suggested he doesn't believe in the R stars and U stars that a lot of economists talk about because they're very hard to know in real time. The one thing he does know, though, is that we're seeing a stronger economy, and he mentioned this, than people had anticipated. Look at that white line there. That's the Atlanta Fed GDP now. And it's forecasting a 5.9% GDP rate for the third quarter. Now, that's obviously going to come down. It's very preliminary, but it doesn't suggest that the economy is slowing down. And when you look at the PCE core, the blue line, and the forecast there, it's expected on Thursday to show an increase. Now, that may be somewhat mechanical, but does that continue? That's the dilemma for the Fed, not only for September, but for November and going forward. Do they continue to make progress, or does the economy surprise and we get a supply-demand imbalance widening again? We do have a lot of numbers this week that everybody is taking a look at. Of course, tomorrow we get JOLTS. We see job openings start to decline. And Wednesday, ADP, which we always talk about as something that the market likes to trade on, but doesn't tell us much. We'll see this week. PCE inflation, I mentioned, and Friday is, of course, the jobs report. Right now, it looks like the reaction to the Jackson Hole speech from Jay Powell and everything else that people said is a little bit tighter. We can see the Fed funds curve rose a little bit so far today compared with last week, but it's really going to be this data. Check back with us next Monday and we'll see how the markets are positioning themselves once we get through these big numbers for the September 20th meeting.
Things can change quickly. One payrolls report, one CPI report. Mike McKee, we might be talking about something else. Mike, just going through the South side and some of the reaction. Neil Dutta, Renmac, called the speech neutral. Bank of America, Mike Gapin, called it balanced. Mike Feroli at JP Morgan said no surprises. I think Morgan Stanley's Alan Zentner talked about patience. How would you characterize that speech, Mike? You were there.
I would call it a hawkish cast to stuff he said before. He didn't break any new ground other than suggesting the economy is stronger than anticipated, but he did put it in such a way that it was a message to the markets that we are not done and don't think we are.
Mike McKee, thank you, sir. I was going through that speech again yesterday evening, and just going through the body of the speech, he talks about economic growth, he talks about the labour market. On the segment on economic growth, there's a conclusion there where he basically says that if we continue to get above trend growth, it would put above target inflation at risk and could warrant further tightening of monetary policy. He said something similar on the labour market as well. He said evidence that the tightness in the labour market is no longer reason could also call for a monetary policy response. So you get this sprinkle of hawkishness on economic growth, on the labour market, and then you get this in the conclusion. There may be significant further drag in the pipeline. Megan, can I come to you on that? How much further drag is there in the pipeline from the hiking they've already done?
Sure, John. Yeah, I would say that those two passages that you highlighted really caught my eye in his speech as well. And that's kind of why, as was highlighted, right, it was a pretty mixed signal. The ultimate drag that could still be in the economy is what I think some refinancing risk, right? Some risk that corporates, companies ultimately will have to borrow at much higher interest rates than what they'd previously locked in at. That's one big key risk to further tightening coming from the already very high real policy rates that we're seeing across the curve. But I think one of the big takeaways from the speech as well was Powell admitting that they really do think that they're already at a restrictive policy rate setting. This is suggesting here, right, that the hiking cycle is almost over. Maybe we've got another hike left, but still really coming back to the distribution of risks around inflation and what that means for how long the Fed's going to hold for a longer period of time.
Matt Miskin, I'll throw the same question at you. Just how much drag is there in the pipeline?
I mean, mortgage rates back now over 7.5%. Credit card interest rates highest in history, about 20%. Auto loan interest rates are exceptionally high. It is amazing that this economy is potentially reaccelerating right now, given how high interest rates are. And in our view, it's unsustainable. It's not going to be able to manage these high interest rates. Eventually, that is going to be felt. The housing market is likely to be somewhat decelerating from here after this reacceleration. And global PMIs are starting to downtick. I know we're trying to save that China bit, John, for a little bit later on, but it's not just a U.S. story here. It's a global story, and there's a weight tied to the U.S. economy and global growth that's going to be dragging it as well. So you've got both the Fed and global growth, or Fed policy tightening and global growth potentially slowing here. To us, you got to manage risk. You got to find higher quality assets across the board to really lean into as it's going to be harder for companies to navigate this challenging macro backdrop.
Patience, Matt, patience. We'll get to China in about 5 minutes, I promise. Megan, that was something that stood out for me in a conversation with Patrick Harker at the Philadelphia Fed. He kept pointing to anecdotal evidence, conversations that he was having in his district from companies, from businesses that were saying, look, there's a struggle here with rates this high. And you heard something similar from the retailers in the past week as well. We heard it from the likes of Dollar General, from Target, from Walmart, from Foot Locker, from Dick's Sporting Goods. Megan, do you think the retail commentary is more important than the hard data, the retail sales at the moment?
Well, John, the issue, right, is that a lot of the data that we're looking at is lagged. And this is why when the Fed is at this restrictive policy rate setting, they know that they've done a lot already. They're thinking about what more is in the pipeline. This is all the argument for them not continuing to hike aggressively, really slow this pace of hikes, and wait to see how the economy develops. And yeah, I do think that there is some divergence between some of the earnings that we're hearing, as you mentioned, from retailers, and some of the data that's currently sitting under the Fed's feet, which is pointing to this very strong divergence picture between the growth that we see in the US and the growth story that we see elsewhere. I guess I would just add one thing to this discussion too, which is you have a pretty different fiscal backdrop that we have in the US versus other regions, which can also help support some of the growth divergence that we see in the US versus other regions and make just the US economy less susceptible to some of these downside risks.
So Megan, the message high for longer seems to resonate with you a little bit going into next year. Tell me the story here. Pricing in more hikes or just fading the cuts? What's the stance for you and the team?
John, the stance is that with the data, specifically the labor market data, so strong, the distribution of risk means that we could be seeing the sweet spot of inflation right now, but the Fed is worried about it accelerating. They don't believe in this immaculate disinflation that we're currently seeing. And while the data under their feet is still pointing to good news on the inflation story, it just means that they're going to hold rates higher for longer. The market's still pricing about 110 basis points of cuts next year. We think that that should be priced much closer to 75 basis points and really at the end of the day see risks to them holding even higher for a longer period of time and delivering less than those 75 basis points of cuts.
Matt Miskin, on that final point, final word, please.
You know, in past recessions, the 10-year Treasury yield has fallen 2.5% to 3%. The Fed funds rate's been cut about 4.25%. That's over the last 3 on average. Look, if we get a recession, yields pricing a lot lower in our view. And in our view, it's more likely the recession comes, not less, as interest rates have gone up and borrowing costs have gone up. So managing risks, we're not overweight duration yet, but we're looking at it and we're thinking about it as we get in closer to the end of the year.
So Matt, the way you frame it, from what I hear from you, you don't believe this move in the bond market is a reflection of extending this cycle. You think it's a recipe to end it.
That's right.
Yeah, I've heard that a few times in the last couple of weeks. Megan Swiber seemingly taking a different view on things. Megan, Matt, sticking with us. Your equity market on the S&P 500. Equity futures right now positive by 0.5%. Going into the opening bell, some movers. Here's Abby.
And there's a wide selection of stocks moving to the upside, driving those gains, John, starting out with the shares of 3M. They are popping on our own reporting that the company has tentatively agreed to pay more than $5 billion to resolve around 300,000 lawsuits claiming the company sold the U.S. military defective combat earplugs. This, of course, analysts are saying could remove an overhang on the stock. Boston Scientific also up about 5% as the company's heart technology study met its primary efficacy and safety endpoints. And then finally, Hawaiian Electric Industries absolutely soaring, up 40% as the utility is saying that its power lines were out for hours before the second deadly blaze. Of course, there was the morning blaze where it was found that utilities, the lines being down with high winds, perhaps caused a fire, but that the second deadly blaze, they had already de-energized their lines.
Abby, thanks for the update. More from Abby around the opening bell. Coming up, China's latest efforts to support the market missing the mark.
China has been a disappointment, no question. Given the problems that they're having right now, it is inconceivable to us that we do not see aggressive fiscal and monetary policy in China looking out over the next 6 to 12 months to try to reverse those fortunes.
Matt Miskin is itching to talk about this. Matt Miskin, Megan Swiber, David Sasser, and Bloomberg's Anne-Marie, all of that up next on China.
does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
This is Bloomberg.
China's problems are real because I think they did have a turning point with the zero COVID policy in Xi, that there's going to be more people, more money, more capital, more ideas looking to exit. And rather than us deterring China and trying to contain them, what we want to do is put pressure on the regime so that Xi, if he gets paranoid, which he seems to be doing, or gets into self-sustaining, puts up more barriers. And we've seen this movie before. The more barriers he puts up, the more people want to get out.
Adam Poston at the Peterson Institute weighing in on China's slowdown. Stocks paring most of their early gains today as Beijing's ongoing efforts to boost markets are falling flat. Equities initially opening 5.5% higher thanks to support measures over the weekend, including cutting the stamp duty on stock trades for the first time since 2008 and pledging to slow the pace of initial public offerings. The market is down on the year following back-to-back annual losses and underperforming equities stateside by a growing margin. This is U.S. Commerce Secretary Gina Raimondo travels to Beijing, stressing the importance of strong economic ties between the world's biggest economies. Let's get to the team coverage. Damien Sasser of Bloomberg Intelligence alongside Anne-Marie down in Washington, D.C. Damien, first to you. That effort over the weekend falling flat.
Yeah, it fell flat on its face, Jonathan. You know, it reminds me a little bit about the post-9/11. I mean, when the U.S. tried to jawbone up equities here in the U.S., and it really worked here, but is not working there. And I think that speaks to everything we know about foreign participation in the offshore market, A shares, H shares, you name it. So basically, we had it up 5% overnight. It, I think, closed maybe just up over 1%. But really, if you want to see something, Jonathan, look at credit default swaps. Look at 5-year CDS in China. Over the last month, it's risen, I mean, more than any other emerging market or developed market country writ large. A lot of that might have to do with Country Garden, which very well may default in the next week.
Anne-Marie is the Commerce Secretary in a position of strength, given everything that Damien just said.
Well, there's one issue, Jonathan, about this meeting that is also kind of awkward, given the Commerce Secretary, according to Microsoft, those hacks against a number of U.S. officials she was part of that came from a group in China. But when it comes to the economy, it does seem like Gina Raimondo and her counterpart had a frank discussion. And what we do coming out of this is a working group on commercial relationships, trade and investment, and then also a dialogue set up about export controls. Given the fact that the Chinese economy is not doing well, it does put her in a great place to have these frank conversations as she's in Beijing.
Damien, what's left? What can they do now?
It's PMI. That's what's left. We have PMI on Thursday. Look, I mean, we don't trust the data. I mean, that's one of the things Secretary Raimondo is going to be focused on in China is economic transparency and transparency of the data. But, you know, we do have PMI data this week. The market is going to trade off of it. It's expected to be weaker, not so much weaker, but weak enough, certainly where you see manufacturing further into contraction. And on the services side, we're approaching that 50 level.
Damien Sasser, AMH, on the latest in China and the relationship between the US and China as well. Thank you, guys. Matt Miskin, I know you want to get there. This is like a softball. It's an underarm. It's an easy one. This came from Kit Dukes of SocGen. I promised a reread of this quote, so I'll do it again. Christine Lagarde, Jay Powell made it clear in Jackson Hole they intend to see out the fight against inflation. There will be no changing of targets, no premature easing, but the earworm I can't keep out is Mike Tyson's everyone has a plan until they get punched in the mouth. Is China about to punch this US economy in the face?
It's like the butterfly effect, right? So we're seeing that basically it's going to be a deflationary pull through across global economies while they're weakening, while they have the housing market that is going to be still weighing on their economy. If you're going to really just have your economy driven from infrastructure, fixed asset investment, and then you build up so much that you don't have anything left in a decelerating population growth, it's structurally just challenged. And in our view, like Damien said, the PMI this week is going to be huge. That we're going to be watching. But as it relates to China, in terms of the consensus, one of the things I hear is, well, everyone's negative on it. At the beginning of the year, China reacceleration, China stimulus was the #1 consensus call that we found across investors that we surveyed. And so we don't see that as this big gap of, kind of potential swing of sentiment. There was actually a lot of positive sentiment going in, and everyone was looking for this sentiment. We're dying from 1,000 paper cuts of stimulus here, and frankly, it's just not going to be enough to change those structural forces.
A question for US rates. Megan, this is the question that Lisa Shallett at Morgan Stanley asked this morning. Could China woes weigh on US yields? Megan, from your perspective, what's the relationship between the struggles in China and the economy there at the moment, and what might happen or may not happen in the US bond market?
Well, John, we at Bank of America are not really seeing that direct link between the China economic weakness and what we're expecting to see on the U.S. economic side. But what I will say is the one very clear pass-through to U.S. rates is going to be what the implications are from financial conditions. If we do see a very meaningful sell-off in the U.S. equity market, that can help drive some of these flight to quality flows back into U.S. Treasuries. But one thing I would highlight, and I think a big key risk to that, is what we see as one of the key consensus calls coming into this. So when we look at some of our positioning indicators, as of June, what stood out was that global benchmark investors were already very overweight U.S. duration and had a lot of conviction on this rally in Treasury rates that really has not materialized. So the pain trade for them is ultimately the U.S. economy doing better than anticipated, seeing the sell-off in back-end rates alongside that. And I think that at the end of the day, that is what can kind of push rates higher in this environment near term without seeing some of this negative economic pass-through to financial conditions and the equity market in the U.S.
Megan, that's the pain trade. What's your base case?
Base case, John, is that we do see 10s coming back down to 4% by the end of the year. We do see kind of time and time again, the end of the hiking cycle is usually the time to buy duration. It's the time to leg into that position. But again, near term, I do think that the pain trade is higher rates, particularly at the back end of the curve, where we've seen that very strong demand from the asset manager community. Historically strong inflows into fixed income funds that have been extremely supportive of taking down very large deficits and the financing of those deficits that we have here in the U.S.
Megan Swiber, Matt Miskin, to the both of you, thank you. Going into the opening bell about 7 minutes away. Your equity market on the S&P 500. Elevated, futures up by 0.5%. Megan talking us through the bond market there. The prospect of coming back down to 4% on a 10-year. Yields coming in just a touch today. We're down 3 basis points at about 420 on a 10-year. On a 2-year, just short of 5.1% earlier on today. 5.06% at the moment. We're down about 1 or 2 basis points. Coming up the morning calls and later, Morgan Stanley's Dan Skelly says the earnings upside surprise was already priced in. Why he thinks it's time to sound the news. That's 7 minutes away from New York. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisce with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Equities up. Let's get you some morning calls. First up, Morgan Stanley downgrading CrowdStrike to equal weight from overweight ahead of 2Q earnings, citing the likelihood of a cut to consensus estimates. Argus upgrading Emerson Electric to buy 110 price target, citing the company's new growth profile. That stock up by 0.6%. And finally, Philip Securities upgrading Nvidia to buy 645 price target, pointing to data center growth and an even stronger Q3. That stock marginally positive. Coming up, Morgan Stanley's Dan Skelly on why he's cautious on equities heading into next month. Your opening bell just around the corner.
Third kid? What if she likes playing golf? It's expensive. We're outlawing golf. Wait, can I still play?
Since we work with Empower, we don't have to worry about planning for a third kid. You can still play golf.
Of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
off the back of a week of gains on the S&P 500, about 20 seconds away from the opening bound. The first week of gains on the S&P of August so far on a final trading week of the month before September. Where does September come from? Futures right now positive by 0.5%. There's your opening bow. Switch on the board and get to the bond market. On Friday at the close, two-year yield on a closing basis, new cycle high this morning, 5.1%. Backing away just a little bit. On a 10-year as well, we're down 3 basis points to 420. On a 2-year right now, down about a basis point or two to 5.06%. The euro showing a bit of strength, 108.06. Euro dollar positive, 1/10%. Going into the ECB meeting September 14th. Christine Lagarde speaking to our good friend TK, telling Tom basically nothing about September. Very, very unlikely to get any guidance from that ECB going into next month. They want to keep it as vague as possible. Chairman Powell does as well. Outside of that, looking at the commodity market, $80 and about 2 cents, up by 0.2% in the crude market. 30 seconds, 40 seconds into the session, we advanced by 0.5% on the S&P. On the Nasdaq, up by 0.75%. One stock to watch at the open is 3M. The company tentatively agreeing to pay more than $5.5 billion to resolve over 300,000 lawsuits claiming it sold the U.S. military defective combat earplugs. Abby has more. Hey, Abby.
Hey, John. And on this, we do have the stock popping higher by about 6%. Its best day in 3 months. And analysts are saying that this could be another overhang removal for the company because, of course, they recently also agreed to a roughly $12.5 billion agreement around clean water litigation. But relative to this case, it's been going on for, or I should say cases, overall litigation, it's been going on for more than a decade. And yes, Bloomberg, we are reporting this morning that they are tentatively agreeing to pay $5.5 billion for those roughly 300,000 claims. Now, one reason could be there have been about a dozen cases that have been resolved in the courts that have already resulted in $250 million awards. So you can only imagine if that's extrapolated over 300,000 cases. And an issue, of course, are these earplugs. We have some of the military where they have a loss of hearing, tinnitus, a buzzing or hissing sensation in the ears. The stock on the year, because of these variety of lawsuits, this one, again, a long ongoing one, into today, down about 18%, really underperforming, the S&P 500. But this seems like a step in the right direction. And with the stock up 5.7%, investors certainly seem encouraged, John.
Abby, thank you. Thanks for the update. The day ends in a Y, so there's a company somewhere talking up its AI effort. Here's DoorDash, the company rolling out a new AI tool that helps fill takeout orders to help understaffed restaurants meet demand. Ed Ludlow has more. Morning, Ed.
Yeah, this is a story of where AI meets the old school, Jonathan. The stock actually lower by 0.5 percentage point. It had jumped about 0.7% when this news hit at the top of the hour. It is an AI-powered voice system. And what DoorDash is saying is that actually the vast number of restaurants on their platform still take the majority of their orders over phone, not through the app. The problem being that 50% of those calls go completely unanswered. This AI tool is designed to answer the calls in peak time so that the staff physically at the restaurant or otherwise can get on with doing what they're doing. Multiple language available. It's interesting because we've reported quite a lot about what DoorDash is doing in the field of AI. In July, we reported about Dash AI, which is a generative AI tool allowing you to conversationally order. The company's never confirmed that it's working on that beyond talking about experimental initiatives in earnings calls. This is a more formal step forward with its AI voice assistant. It's a stock that's up 60% year to date, but still a few percentage points away from making up its 2022 loss. And you have to go back to December of 2021. This was a stock that was trading at its pandemic peak, $245 a share. We're now down, John, at $77.90. But a lot of AI momentum behind a number of the gig economy names, a real emphasis for all of them.
We got a life, Ed. We started going out and socializing again. It's a good thing.
Exactly.
Ed, thank you. Thanks for the update. Let's turn to utilities. Far more serious story. Hawaiian Electric providing an update on the cause of the wildfires in Maui. The company saying this, important quote, a fire at 6:30 a.m. appears to have been caused by power lines that fell in high winds. At about 3 p.m., a time when all of Hawaiian Electric's power lines in western Maui had been de-energized for more than 6 hours, a second fire began. Katie Greifeld has the story. Katie, the company just going through the timeline of events over the last couple of weeks.
Yeah, and let's talk about that timeline a little bit more. That fire on August 8th apparently was caused by falling power lines. The company did say that, but Hawaiian Electric also said in that statement today that the second blaze that swept through Lahaina, it started more than 6 hours after they shut down their power lines in that area. And of course, this statement comes after Hawaiian Electric was sued by both investors and Maui County last week. They claimed that the utility, it didn't cut its power, and it also failed to take safety measures to contain the fires. Now, Hawaiian Electric countered, saying that it's, quote, surprised and disappointed by that lawsuit. Has yet to be shown that the utility bears responsibility. So we'll see how that works out. But you take a look at the stock today, it's absolutely flying up about 47% at the moment. That's its best day ever after an absolutely brutal wipeout over the past few weeks. Coming into today, it had been down close to 70% since those fires began, John.
Brutal, the right word, Katie. Thanks for the update. Appreciate it. About 5 minutes into the session, here's an update on the market. Up by 0.7% on the S&P, a lift of more than 1 percentage point on the Nasdaq. I want to turn to the EV makers. XPeng agreeing to buy DiDi's smart car development arm to consolidate the market. XPeng CEO saying this: the partnership will ensure better than expected initial scale for the car and achieve a combination of goals in innovation and supply chain management. Simone has the story. Hey, Simone.
Hey, John. Yeah, XPeng buying the smart vehicle unit of ride-hailing company DiDi Global. This deal, worth about $744 million, all stock, will leave DiDi with a 3.25% stake in XPeng. And there's two main things we accomplished with this. One, it eliminates a potential competitor for XPeng. Second, it gives them this new partnership. And part of this new project, Project Mona, it has been dubbed. The companies will develop and launch a smart EV model next year that's really targeted toward the mass market at a price point just slightly higher than $20,000. They've also discussed potential other collaborations within fleet management, charging facilities, robo-taxis. Maybe we're seeing as well some impact here of Beijing's steps to shore up investor confidence in the stock market. We did see shares of XPeng much higher in the pre-market. These are ADRs, of course, and we've seen them retreat a little bit, now up about over 2%.
Simone, thank you. Can't wait to talk about the automakers. We'll do that with David Welch a little bit later in the program. We'll catch up with Katie Lyons as well about the potential for a strike. The ask is a 32-hour work week, a 46% pay rise, an ask that the union themselves called audacious. Looking forward to that conversation taking place in about 10 minutes from now. Here's the debate of the moment. Evercore's Julian Emanuel addressing that debate, writing this: reaction to Nvidia earnings added to the wall of worry. Surging interest rates, China and Europe slowing, US retailer caution. Here's the question: is the pullback more than a seasonal setback? Morgan Stanley's Dan Skelly says it's time to sound the news. He writes this: recent earnings updates from the perceived AI beneficiaries indicated that a lot of the earnings upside was already reflected in valuations. Dan joins us now for more. Dan, let's start there. And great to have you with us, buddy, as always. Nvidia's big beat was not rewarded on Wall Street. It did not lift all boats. It did not even lift Nvidia. What do you think that signals, Dan?
I think it signals that more patience is warranted, particularly, John, as we go into a seasonally weak September. And as the quote of the day on your terminal said, genius is eternal patience. I think that was also the message coming out of Chair Powell over the last week or so at Jackson Hole. The idea being that we've seen some slowdown in the data, but we're just now at a level where Fed funds has breached or has eclipsed the rate of core inflation, which historically, going back 40 or 50 years, has been a meaningful point and a meaningful inflection point where inflation does start to meaningfully come down more. So I think we still need to be patient here, John.
Dan, whenever we talk, we often do this. We talk about the incoming information and how the market responds to it. Your colleague Mike Wilson pointed to that Nvidia move and said this was a sign the market was exhausted. This rally, this move we've seen all year, we've exhausted it. From your perspective, Dan, can you add to that more specifically? What else can you point to outside of Nvidia as a sign that maybe this rally has stalled?
Absolutely, John. So if you look at the broader market beyond NVIDIA, and of course, NVIDIA is the poster child for all things AI exuberance this year in the Magnificent Seven. But when you look at the broader market, John, broadly speaking, earnings beats were not as rewarded as significantly as historically they had been, right? And misses were penalized fairly aggressively as well. So what does that tell you? That tells you that we broadly had a very high run-up coming into this earnings season. We've had now, even though earnings were better than expected once again, they were still negative. We've had 3 consecutive quarters in a row of down year-over-year earnings. And I think what it's telling you more broadly, John, is that the market just doesn't believe the sharp reacceleration in earnings embedded in 4Q and later into next year.
There is some caution out there. Dan, we heard it from the retailers. You've made the call. The consumer's deteriorating. Now, Dan, are you hearing that from the companies, or do you see that in the data?
It's a mix, John. So if you look at broadly the card companies, the processors, the banks, that's where you can get the widest scope in terms of consumer information. Because let's not also forget, we're also in a post-pandemic world where business models are being challenged and market share and innovation and all different types of consumer preferences are at play as well. And so I think you want to look at the banks and the card companies as well for a broader read on these different trends. And the broader read is, yes, you are slowing. You're by no means falling apart, but you are slowing from some of the aggressive spending levels we've seen in recent quarters, and that was somewhat to be expected. But John, let's not forget that one of the key drivers in this cycle has been fiscal, and now with student loan repayments coming back later this year, we continue to see that slowing coming forward.
Dan, how would you reconcile that? How do your views on the consumer compete with your outlook for inflation?
So there's some nuance. There's an excellent question. There's some nuance there, particularly as it pertains to supply. So when you consider in particular 2 incredibly big markets that matter, housing and labor, there's demographic shifts that are very important in both of those. And there's some cycle shifts, right? Post-08, no one invested in new housing stock. So we estimate we've been 4 million units short annualized for well over a decade. So that coupled with the rise of the millennials, family formation, housing formation that would have happened with that demographic shift has put incredible strain in terms of the housing market. Similarly with labor, as the boomers were starting to reach the end of their careers and their working age period, we had labor issues before COVID. And John, as you know, that's only been accentuated post-COVID, given all the different health issues.
Well, listening to some of the demands from UAW, the United Auto Workers Union of Detroit, Dan, I'll go through some of those demands now. Proposals for a 46% raise, a return to traditional pensions, a 32-hour work week. Dan, on the one hand, you're saying weaker consumer. On the other, you give me this nuanced view on inflation. Does that smell like stagflation to you, Dan? What is that? What would you call that?
There's a bit of a risk there, John, related to slowing growth and sustainably higher inflation. And you use the S word, stagflation. And look, John, I know your work ethic. I mean, you've probably had days that felt like 32 hours, given what you do early in the morning. But the reality is, in some of these super labor-intensive verticals, autos, airlines, we continue to see the leverage, right? We continue to see the leverage on the behalf of the worker. And this, too, has been accentuated post-COVID. Right, we've got a little bit of this K-shaped recovery going on socioeconomically, where higher income earners continue to travel, continue to spend on service. And where have some of those labor issues been the most acute? It's in those labor-intensive service industries. So that is adding to the nuance, as you appropriately highlight.
So Dan, sector calls. We seem challenged at the index level, according to what you've told me so far. Doesn't sound like a constructive view on things. Beneath the index level, Dan, sector to sector, what do you like, what don't you like?
Absolutely, John. So when you think about near term, right, let's go back to earnings expectations and where things have run and where they haven't. Healthcare stocks had really nice reactions to their earnings, whether it was pharma, managed care, devices, and we've seen actually a pickup in volumes in some of those surgical procedures as consumers have prioritized that as a key area. And we talked again about consumer preferences post-COVID a minute ago. But again, notably, expectations were reasonable enough that the reaction reactions were positive. So healthcare, John, continues to be an overweight sector for the firm and for our portfolios, given a mix of defensiveness, reasonable expectations, and let's not forget, as we've pointed out in the past, while the market is focused almost exclusively on the enablers of AI, the semis, some of the internet plays, it hasn't focused as much yet on the beneficiaries. And we think the healthcare industry is certainly ripe for benefit from AI and new innovation. So that's a key conviction. Beyond that, we want to look at some of the power, utility, and energy-related sectors as well. You know, one of the strikes we did not mention so far is going on right now in Australia, looking at LNG and some of the issues down there. And we've seen a pickup, obviously coming into the shoulder, into the storm season in commodity prices. So energy is another area where we think expectations are reasonably low enough. There are defensive balance sheets, particularly in the integrateds, and there could be some catalyst in the future.
Hey, Dan, thanks for the update. Dan Scully there of Morgan Stanley. The update on their view on this market. About 14 minutes into the session, equities advancing by 0.6% on the S&P. On the Nasdaq, just off session highs, up by 0.6% also. Coming up next, United Auto Workers threatening a strike on the Detroit 3.
Obviously, I'm concerned. I think that there should be a circumstance where the jobs that are being displaced will be replaced with new jobs.
Team coverage up next.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Paul Jacobson assured me that when he takes the new Hummer EV on long journeys, it's not just fun to drive, it's equipped to go the distance.
I hear so much about road trip anxiety that I wanted to experience it myself. My family likes to drive a lot, so I brought my daughter home from college in this, and it was great. I mean, the computer system is all intuitive. It tells you how to keep track of the battery. It tells you where the charging stations are. It tells you how much power you'll have when you get to the charging station. So it really puts a lot of your anxiety at ease. But as far as driving it, it's a treat.
So where are you on the charging stations? I know General Motors has made an investment in one company. How are we doing in this country generally in getting charging stations in?
So I think this is an area where obviously we can continue to improve as a country and a society. We're doing our best. We've committed almost $1 billion to EV charging. So we've taken that and looked at home charging solutions, local community solutions, and road trip charging solutions. With my daughter, what we would end up doing is probably stopping, grabbing a bite to eat, plugging it into a charger, usually a high-speed charger, to get as much charge as we can, and being there for 20 to 30 minutes. Get us a lot of range, and by the time we've used that range, we're tired, ready to stop again, etc. So it was a really good experience for me, and it's taught me, number one, what are the concerns of the consumer that are ultimately going to drive our vehicles, and then number two, where do we need to focus on addressing some of those anxious points for people.
On the next episode of The Circuit.
And I've heard you say you were really motivated by the fact that a lot of people didn't think you could do this.
I think even today I'm underestimated. And I think even today Bumble is underestimated in terms of what we can be and what we can do in the world.
Watch The Circuit now on Fire TV channels.
Obviously, I'm concerned. I think that there should be a circumstance where the jobs that are being displaced, replaced with new jobs, they should go to the first choice should go to the UAW member who had the job, and the salary should be commensurate.
President Biden speaking to reporters going into the weekend, looking for a deal between the United Auto Workers Union and Detroit's Big Three. Differences remaining on everything from pay to transitioning to electric vehicles, raising concerns about a potential strike when the current contract expires next month. Senator Bernie Sanders weighing in on CNN.
I very strongly support the UAW and their new leadership standing up and fighting back. And I certainly hope there is not going to be a strike. No one wants a strike. But the Big Three have got to understand they cannot have it all. They can't make huge profits, give exorbitant compensation packages to their CEOs and ignore the needs of workers.
Team coverage starts right now. Katie Lyons in New York, David Welch in Detroit. David, the Tom Keene question, I think, is the right question. Are we going to get that strike?
I think there's a very good chance we will, with at least one of the companies. Whether or not they go out on all three remains to be seen. Usually they pick a company and they try to cut a deal with them that will set a pattern for the other two. We're not sure if Sean Fain will do that, but I think probably he goes on strike with one of them to set the tone that the union's very serious about the demands they've made.
He himself called those demands audacious. David, talk to me about those demands, how realistic some of them are. 32-hour work week, 46% raise, traditional pensions returning. How realistic are these asks?
Right. So look, before he made that list of demands, Sean Fain and the vice presidents had a series of Facebook live chats where they talked about their priorities, which were better pay, getting entry-level workers and temps better pay for them, getting them closer to the $32 an hour top wage, making sure battery plant workers are taken care of, inflation protection, job security for workers who make engines and transmissions, those kinds of things. They didn't mention back then 32-hour work weeks or pensions. That sort of came after Sean Fain started talking to his members. So I think the very realistic demands are that first set, mostly about pay, taking care of younger, newer workers, getting a better compensation package for temporary employees, maybe making them permanent, and workers at battery plants, and trying to secure the future of electric vehicle employees from here on out. 32-hour work week, I don't see it happening. It seems like something that kind of was thrown in at the last minute. And the auto companies will fight very hard not to get back to a defined benefit pension plan. Most new hires now, or say post-2007 hires, have a 401k like most people have these days. Those, retiree health care and pensions, those were huge items that played a role in Chrysler and General Motors going bankrupt over a decade ago. I don't think they're going to want to go back to that, and they're going to fight very hard against it.
Katie, you and I have talked about this all morning. How does the president, this White House, thread this needle?
It's a very difficult line to walk, John, on two fronts. One is that President Biden has billed himself as a pro-union president and also as a climate president. As David is talking about the fact that this all does fundamentally come down as well to the EV transition, that is a transition the president is trying to accelerate through legislation like the Inflation Reduction Act. But he also is a president who has said repeatedly he wants to support unions. How does he do that when he also wants to avoid a potential strike of 150,000 workers? Very difficult conversation. And he has been active. He has spoken, said that he has been speaking with the UAW. He put out a statement earlier this month urging the two parties to come to a fair agreement, saying that the clean economy, clean energy economy should be a win-win for both parties here. The other added difficulty, John, is that if the administration needs to get involved in these conversations in a more material way, they will be doing so not with a confirmed Secretary of Labor, but still just an acting one, as Julie Su is still only serving in that capacity.
Amazing. What a story. Katie, David, thanks for the update. We'll continue this conversation on Bloomberg Surveillance tomorrow morning. About 22 minutes into the session this morning, we're positive by 0.4% on the S&P, on the Nasdaq up by 0.3%. Those gains fading just a little bit. With the latest, here's Abby.
Well, John, we are looking at a second up day for the S&P 500. We may be fading just a little bit, but the two up days, the best since the middle of July because of the August declines. On the day, though, moments ago, to your point, we did have all 11 S&P 500 sectors higher. Now, mainly most of the sectors are higher, but two of the mega cap tech sectors drifting down ever so slightly. Energy, the top sector, along with materials, both up 1%. On the month, it's a really interesting divergence. announcements that we have going into month's end. We have the energy sector, similar to today, up, but up more than today, up about 4%, 5%, up for a third month in a row. But take a look at technology. This is the big drag, down 5.4%, heading to its worst month since December of last year, John.
Abby, thank you. As we kick off a brand new trading week, your trading diary is up next.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
Look, I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Potentially a second day of gains on the S&P 500, 26 minutes in, up here by 0.6%. As the price action, here's the trading diary. Tons of data through the week. US consumer confidence out on Tuesday, along with JOLTS data and Best Buy earnings as well. On Wednesday, we'll get US GDP numbers, another round of jobless claims on Thursday, and Friday, the main event, the payrolls report just around the corner. The estimate at the moment, just a sneak peek at a Bloomberg survey for you, 170K. As the median in our survey at the moment, down from 187 in the previous month. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time.
And then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
City, in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
There, the kind of upside.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day, Monday, August 28th. Here are the top market stories that we're following for you at this hour. You got the China fizzle. The government.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Mike McGlone, Senior Macro Strategist with Bloomberg Intelligence. We're going to talk all about the commodity space, maybe throw in a question about Bitcoin. Tom Keene's not here, so we'll talk a little Bitcoin maybe. Brianne Lynch, Head of Market Insight at EquityZen, is going to join the program to discuss the Instacart IPO and the general IPO space. Looking forward to the remainder of the year. And David Dietz, Senior Investment Strategist at PPAC Private Wealth Management. He's going to give us his market call coming up. But first, let's kick this whole thing off with John Tucker and get a Bloomberg Business Flash. John.
And we have green on the screen, Paul, this morning. Stocks pairing their monthly loss with the S&P 500 hovering above the 4,400 mark. Bond yields, they are lower right now. Stocks have struggled this month as the higher-for-longer rates narrative takes hold. You have mega caps, Apple, Alphabet, Meta, they're lifting the S&P 500. Shares of NVIDIA, actually, they are proving to be a drag this morning. And still overall economist Dennis Gartman sees stocks selling off 5 to 10% in the next 6 months.
I think stocks have been overpriced for 6 months. It's been, to me, an egregiously overpriced stock market. Fear and Greed Index got to a high of 85, which is characteristically, that's when markets begin to turn down. That's when the public has been too egregiously involved.
This week, we're going to get a raft of U.S. data that's going to shed further light on recession risks here in the U.S. In the S&P 500, all 11 major industry groups, they are higher right now, being led by energy. This is crude oil prices. They climb. NYMEX crude up 90 cents a barrel at $80.72 a barrel. And the S&P 500, 26 points higher. That's up 0.6% right now at 44.32. The Dow Jones Industrial Average is up 253 points. That's up 0.75%. And the Nasdaq 100, 78 points higher, up 0.5%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Simone and Paul.
All right, John Tucker, thank you so much. We appreciate it. Simone Foxman sitting in for Matt. How are you doing?
Not Matt Miller.
Not Matt Miller.
Here, reporting for duty.
Exactly. Yes. Matt Miller's, he's hanging on for dear life to his European vacation schedule, which is basically half the year off, including the entire summer. So he's out on holiday today. Good for him. He'll be out all week, but we'll be here kind of working it out here. Simone Foxman, Paul Sweeney here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio, and that'll get you where you need to go. A nice start to the week. We've got the S&P 500 up 0.6%. Billy Lipschultz joins us here in our Bloomberg Interactive Broker Studio. He gets a look at all these markets. Billy, what are you looking at today?
Yeah, all 11 industry groups trading higher, 1% moves in energy, communication services, materials, and real estate. Top performers, though, in the S&P 500, Boston Scientific up 5.5%, this coming after a heart tech study met its primary goal. Analysts saying there's little to pick at, checking all the boxes, and expect their Farapulse device to be approved in the U.S. sometime next year, which will bode well for earnings and expanding their revenue growth within that area. Another top performer, 3M, this coming after it agreed to pay more than $5.5 billion over combat earplugs, so resolving over 300,000 lawsuits claiming it sold the U.S. military defective combat earplugs. This obviously had been one of the many overhangs for 3M, which has been doing nothing really for the last 12 months in terms of stock performance. So a number of stocks in the green so far this morning.
Yeah, what struck me there was that analysts believed that this was going to be maybe twice as large of a settlement than they ultimately received. I believe their estimates were for between like 8.5 and $10 billion, and then we only see 5.5.
Yeah, so always positive when you're paying less money to settle those lawsuits.
Of course. What else?
What else you seen out there?
Another outperformer, Horizon Therapeutics, up 5.6%. This is a company that was agreeing to be acquired by Amgen for about $28 billion. One of the two big biopharma deals being put on ice by the FTC, but we actually saw a positive outlook from analysts after the FTC paused its challenge of that acquisition, saying the hiatus will happen until September 18th. So analysts reading between the lines that there could be a settlement on the horizon. So positive news in the deal space. Paul, I know we've talked a number of times about kind of the chill in deals given the FTC's push, so it does seem like another win for deal making, at least in the biotech space.
Yeah. Interesting, because I suppose the FTC has come out and just been so much more activist recently to see a deal like this go through.
Yeah, and then one of the worst performers, Novocure, ticker NVCR, pretty small company, $2.1 billion right now, down 33%. Their ovarian cancer trial did not meet its main goal, so you're seeing some movers and shakers to the up and downside across the healthcare space, which is an industry that I personally follow closely, just given that's where I started covering here at Bloomberg.
Yes, we're going to have a guest coming up later this half hour talking about the Instacart IPO. Talk to us about just the IPO market in general. What are you hearing from the street as we kind of wind down this summer here, and maybe people come back to work and maybe people start thinking about deals?
Yeah, we've got Instacart flipped their S1 on Friday. Last week on Monday we had ARM, so two of the more closely watched IPOs coming on the horizon. Clayvio, another company that flipped their S1 last week. So it does seem like we're getting ready for a kind of busy post-Labor Day stretch with some of those roadshows, with investors getting a chance to look at the numbers for a number of companies. ARM obviously is the chip designer bought by SoftBank, so more of that private equity kind of flavor, whereas if you look at an Instacart, your more typical VC-backed technology company, though they did report quarterly profit for the last 5 quarters, and so one of those many companies tightening their spending, using things like advertising to bolster profits, and that's one of those big things that we're going to keep an eye on as we see some of these companies go public, is where investors want to put money to work to and what those valuations look like, just given kind of the risk-off mentality of IPO investors, given what we saw in 2020 and 2021 with so many of those companies trading, 50 to 60% lower than where they IPO'd at.
I know, but it's funny. It's hard to say, oh, well, there's a risk-off atmosphere, too, when you look at the S&P 500 up 15.5% year to date. Clearly, there have been some gains there for some companies. Are there any, threads that you can pull through among companies that have started to come out and push for these IPOs? Are there things that investors want to see?
Profitability. It's a path to profitability, and if not profitability, a clear path to that. When you look at some of the better performing IPOs that we've seen so far in the U.S. here, many of the top performers who raise actual cash, you're looking at Kava up 89%, not quite profitable, but the expectation that they could be, the Mediterranean Chipotle. You're looking at strength for other companies like Oddity up 19%. The big question is, can you deliver on those expectations, and what will investors pay up? When you look at Instacart, BI analyst Mandeep Singh expecting that they will have their market cap around the $10 to $12 billion range. Well, they raised it $39 billion in 2021.
Is that right?
So
holy cow, that's a down round.
So they slashed their internal valuation last year to closer to $13 billion. They did about 3 or 4 cuts. So the question going forward is, what are investors going to pay for Instacart? You had the growth, you had the pandemic boom, but now you have to kind of reassess that.
All right.
So
boy, that gets your attention there on the valuation front. That's a tough pitch to make. I can imagine going there saying, all right, we're going to value it like 1/3 of where you were just a couple of years ago.
Yeah, I mean, the one thing they do have going for them is they have PepsiCo buying some buying preferred shares, I think $175 million. They do have some cornerstone investors who have been in the stock for quite some time, deciding they want to pony up to buy up to $400 million in the IPO. But Paul, as you mentioned, that's a tough haircut. Again, close to 70% below their valuation of what they were valued at.
I don't think I can't remember seeing something like that, certainly of that size, in terms of dollar amount, and seeing that kind of haircut.
Yeah, and then you have to wonder, like, is that all that's done? Is everything behind us? Have we gotten through?
And there's some
all
private equity players in there that had to sign off on that deal, Sequoia and some others.
T. Rowe, you got a number of companies that have put a lot of cash to work with that, again, in tandem with the traditional VC investors. So that is one that will be very interesting to watch, again, just given how cold the market has been.
And the good thing for Bloomberg Terminal users is Bloomberg Intelligence has a research report out on Instacart, so nobody else on the street has one, but Bloomberg Intelligence does, so head to BI Go and check that out. Bailey Lipschultz, thanks so much for joining us here. Bailey Lipschultz covers the markets for us. We appreciate getting his insight here on a positive day. All right, speaking of Bloomberg Intelligence, I'm reading some research here. It says, most commodities are melting except for gold. What stops it? Let's go right to the person who wrote this stuff, Mike McGlone. He covers all the commodity stuff. He's a senior macro strategist for Bloomberg Intelligence. Mike, what are you thinking about these days in terms of the commodity space? What are you telling your clients? What are the conversations you're having with your clients about commodities?
Well, hello, Paul. I appreciate you reading that headline because it's something I like to reiterate periodically, particularly when it's relevant, is typically, historically, over time, gold is the best performing commodity. Now, basically, because it's not really a commodity, it's a store of value. It's a metal. I mean, you can store it on your body in terms of jewelry, but certainly lately, it's been the key case. It's the best performing commodity this year. It's up 10%, and the average of the Bloomberg Commodity Index this year is down 16%. And the key thing I like to ask myself is, those are bodies in motion. And as a strategist, I say, okay, is it going to stay the same, reverse, or accelerate? I think it's more likely to accelerate, particularly at some point if we get to a point where the Fed pivots. It's going to happen. But that's the bottom line is we had this massive pump in commodities last year, and they're proving what they always do. Elasticity, supply, demand makes commodities their worst enemy. It's the higher price cure, as the farmers say.
Well, but that's interesting, though. I feel like we're a far bit away, at least if you listen to Jay Powell on Friday, from when we see the Fed reverse course. I mean, talk me through the timeline there. When would you expect, gold to start showing some outperform? I mean, I guess it is showing outperformance, right?
That's the point. Gold's looking ahead, and that's a key point. They will probably not be cutting rates anytime soon, particularly in my view, until the stock market tells them to. And that's part of the lose-lose for risk assets. There's then a high connection and correlation between stock market bouncing this year, all this massive fiscal stimulus, and the Fed hiking another 100 basis points. They are still on that hiking trajectory. Despite then, you look over commodities, what's the number one source of demand historically, at least the last 20 years or so, is China. Demand estimate revisions heading lower in China are just getting started. So their key customers, their key export customers, U.S. and Europe, are in these early days of just showing signs of what you expect from high interest rates jumping. And then, of course, the leader of China, President Xi, cozied up with Putin right before the war. So we see that tilt just get us out. And so that to me this is early days. So I look at this as what's normal is potentially a very bearish scenario for commodities. And you look at yourself, so what's going to change is typically also you need a weak dollar. And for the dollar to get weak, we have a major issue there. It's the hardest to, most expensive to short commodity or currency on the planet, particularly if you look compared versus the top commodities economies on the planet, China, Japan, and Germany. U.S. is just a much higher rate. So that to me is basically a train wreck heading for commodities and for deflation.
So, Mike, I know you come from the land of the great American farmer. I wonder how the American farmer's doing here. I'm looking at corn down 30% year to date, soybeans down 8% year to date, wheat down 26% year to date. How is the farmer doing these days?
They are crushing it. So
even with prices down so much.
Oh, well, down from where they were. So corn right now, the number one, as I'm going back next week, and a lesson I learned growing and raising and having owned the farm in the Corn Belt, we plant soybeans so we can plant corn. We plant corn because that's what we do and that's where we make our money. It's the world's most significant commodity.
Wait a second,
that's
you plant soybeans to plant corn? Why? How's that work?
It's a rotation because soybeans add nitrogen and fertilizer to the soil. And they're a legume. Corn takes it away. It's very nitrogen expensive. It's a grass. It's just that rotation that the Corn Belt has crushed. But the bottom line is partly because of this war in Europe, you've had prices well above their costs of productions. And the costs of production, for instance, anhydrous ammonia is collapsing. And so we're making a lot of money. It's just called profits. What do profits mean for farmers? Production. So this year is probably going to be close to the biggest production year ever for corn. Just in the weather's not so great. And also, what did it do with corn and soybeans in Argentina? And I'm sorry, in South America, but most notably in Brazil, record production. I mean, off the charts. So this is just a normal elasticity of supply and demand in the area of the commodities we can bring on that supply in 1 year. And the bottom line is they're making a lot of money. And that means more supply, more production, and it means typically lower prices. But I'll just end with this. September is the worst month of the year for grains, typically because of harvest. And that's how futures came about, because they needed to start hedging, most notably when they all tried to sell at the same time.
And I've been looking at, I've been pulling back a little bit our commodity price for corn, and we're still at levels where we were in late 2020, but those are substantially higher than where we were in previous to that. Yep. Talk me through, Mike, what's happening in wheat? Because we have all this stuff with the grain deal and Turkey. Very interested to see where you think this is going also.
So the significance of wheat is that was at the epicenter of what happened with Russia's, President Putin's invasion of Ukraine. But it's been in a straight downward trajectory since reaching that high last year, right around $13 a bushel. But typically what wheat does, now it's back to a level that was kind of enduring before, because what happens is you can bring on wheat supply rapidly, and it's the most widely grown agricultural crop. And almost every country in the world can grow wheat. Now, Ukraine was a big exporter. U.S., we export over 55% of our wheat. We grow less of it every day because it's so much easier to produce. It's basically considered a weed. And it's one commodity you never want to be long after it goes up. It's just the way it works because you bring it on. So wheat's been a good indicator. Right now, it's around $6 a bushel. And I view it's all going to continue to trend lower unless we get some kind of surprise out of that war, which means hopefully not, but something nuclear could do. But this is a situation similar to World War II for the grain belt, the Corn Belt, which is where I'm from, and that is prices. And the war in Europe kept prices rather high, which meant U.S. did very well, created more and more production and profited, and then it all collapsed once the war ended and we had way too much supply. That is the risk, and that's markets are looking ahead to that.
So real quick, WTI crude oil, we're going to switch gears here. $80 a barrel seems to have found a little bit of a home here for a while.
Yes, it's happy. It's consolidating well. It's the same price as, I'll put this back into history. This price here was first traded in 2007. Now, imagine if we said that about the stock market. Yet, over that time period, the PPI is up 50%. In terms of gold, here's one for you. It takes 0.042 ounces of gold to buy 1 barrel of crude oil. That's the same price as 1931. Crude oil is the world's most autocorrelated asset and has a lot of reason to continue trade lower after that big pump last year. 15% of all sales of EVs in the world now are automobiles are EVs. And then, of course, that supply out of the U.S. The biggest thing that's pressured crude oil the last at least almost 15 years is the U.S. We just create much more than we need. And with Canada, our surplus every day is about 4 million barrels a day of liquid fuels. So we can fill up the SPR, the Strategic Petroleum Reserve, in just a few months.
Interesting. All right, Mike, always learn something with you. You put in soybeans to do corn. I learned that. That's new. Mike McGlone, senior macro strategist and Bloomberg's resident farmer for Bloomberg Intelligence. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. Danaher has won the race to acquire the UK's Abcam, paying $24 a share. Now, Abcam makes supplies for the life sciences industry. The total value of the deal is about $5.7 billion, including debt and acquired cash. Shares of Danaher right now, they're up about 1%. Shares of Abcam, ADR right now, down about 4%. And 3M is paying billions of dollars for earplugs that didn't provide enough hearing protection. Bloomberg's Courtney Donahoe has that story.
3M is said to have agreed to pay more than $5.5 billion to resolve over 300,000 lawsuits, claiming it sold the U.S. military defective combat earplugs. That's about half the roughly $10 billion some analysts predicted 3M would have to pay.
Now, shares of 3M right now, they're up about 4%. And Hyundai is feeling the pressure from a group of Southern labor and civil rights groups. Bloomberg's Steve Podisk has more.
The Alabama Coalition for Community Benefits and the Georgia branch of the AFL-CIO are asking Hyundai to negotiate a community benefits agreement to ensure safe labor conditions throughout its supply chain. This as the company is investing $5.5 billion in an electric vehicle assembly and battery plant in Savannah. The company responds its top priority is the safety and well-being of its employees.
Now, shares of Hyundai right now, they are down just a fraction. And shares of EV maker XPeng soared after it agreed to buy Didi Global's smart car development arm. Now, the $744 million all-stock deal will see Didi emerge with a 3.25% stake in XPeng. XPeng plans to launch a new EV brand in partnership with Didi in 2024.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash. Green on the screen this morning. S&P 500, the NASDAQ snapping a string of 3 straight weekly losses. And following that cautious view from Federal Reserve Chairman Jerome Powell last week, investors looking ahead to a week that will deliver some important inflation and employment data as well. We're looking at a forecast of 170,000 jobs from the Friday report. That would be below July's gain of 187,000. Shares of NVIDIA right now, they're the biggest individual drag in the S&P 500, down about 1.5%. Overall, the index is up 27 points. That's a rise of 0.6%. 4433 on the S&P 500. Dow Jones Industrial Average, that is up 251 points right now. And the NASDAQ 100, 90 points higher, rise of 0.6%. Two-year yield, that's turned higher, 1 basis point higher right now, 5.08%. The 10-year is relatively unchanged. Right now, the yield at 4.23%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Simone and Paul.
All right, John Tucker, thank you so much. We appreciate that. Simone Foxman, Paul Sweeney here in our Bloomberg Interactive Broker Studio. We are streaming live as well on YouTube, so just head over to youtube.com and take a look and search Bloomberg Radio, and you'll find us there. That's where we go. The IPO market looks like it might be heating up a little bit. Had a couple of filings late last week. ARM Holdings, the chip maker, and then the grocery delivery company, Instacart. So we want to talk about that deal. Brianne Lynch joins us. She's head of market insight at Equity Zen. She joins us here. So Brianne, talk to us about Instacart here. What did we learn from their IPO filing last week?
Yeah, thanks for having me. I think Instacart really painted a picture in that filing of what companies are going to need to show if they want to have potentially a successful IPO. So this is a company that is growing. They grew transaction revenue 39% year over year. They're profitable with 15% operating margins, which a lot of other players in the gig economy space that are public, like Uber, Lyft, Dash, they all are not presenting, profitability yet. And this is both a brand that people recognize and a business model that people know. So definitely a strong one that could potentially open up the IPO market for others.
Well, the interesting bit as well to me, and we were talking with this about this with our equity reporter Bailey Lipschitz earlier, is that this company had been valued much, much higher as of 2021. I believe $39 billion according to PitchBook. And right. Now, the valuation here are going to be maybe 70% less. Talk to me about how investors kind of get comfortable allowing this company or going along with the company's plans to IPO here. How does this change the dialogue between the company and its existing investors?
Sure. So Instacart has already been priming its investors about this. So while they did raise that $39 billion round in 2021, their internal valuations have gone as low as $10 billion, now closer to $13 billion. So this is for the equity that they're issuing to new employees or, new stock grants. That's the valuation that they've given themselves. So internally, at least, they've accepted that haircut. And I think that's ultimately the tough pill that a lot of these venture-backed companies are going to have to swallow. Is we raised money at a crazy valuation in 2021. It's not where the market is anymore. And if we're going to raise capital in either the private or public markets, it's most likely going to be at a discount. And I think investors understand that as well, just given where multiples are. With the case of Instacart, you have Dash as a public market competitor. That's a pretty good comp that helps from a valuation perspective.
So speaking of DoorDash, Brianne, this has become a crowded space really since the pandemic as this market's really developed and evolved. Where does Instacart kind of position itself in terms of its competition, whether it is DoorDash or Uber Eats or Amazon and all that type of thing?
Yeah, so they're by far the market leader. Both Uber and DoorDash have less than 1% of the grocery market, and it's a market that they're aggressively pursuing, but they still are not big players in it. When you look at all of the grocery players, Instacart has partnerships with over 85% of them. And this is a $1.1 trillion market. The largest retail market is grocery. So it's a huge market where they are already the leader. So there is a lot of competition, but they are 1 foot ahead. But to your point, it's not just these other kind of gig economy players they're up against. They're up against Amazon Fresh. They're up against Walmart grocery and other players that, you know, have a lot more resources just from being bigger companies. So there is a lot of competition.
Yeah, does that competition scare would-be investors in this space at all? Because, you know, you think of Amazon coming into any space and it's just sort of, you know, has the potential to be transformative, even if they've struggled a little bit with expanding their grocery footprint.
Yeah, so they got a strong vote of confidence by Pepsi, who's investing $175 million in this IPO, and a lot of the thesis or you know, the bull case that they see is around the advertising piece of Instacart's business. So about 30% of their revenue comes from advertising. So when they highlight different products you know, on their marketplace to users, and this actually helps diversify their revenue stream in ways that, you know, some of these other players haven't done yet. And it's also the piece of their business that is driving their profitability. So that's kind of a unique or, you know, a strong point that they have now that investors have found compelling.
Growth has slowed a little bit for this company. Is that just a post-pandemic kind of evening out of this marketplace in terms of number of subscribers and in terms of that metric?
Yeah, in terms of, I would say they haven't saturated the market fully, but, you know, they did see such growth during the pandemic that it's probably more about activation. So of these customers you have who have used Instacart, how do you get people, you know, more captive on the platform? They haven't admitted and understand that it's not going to be online only for every customer. People will still be going to stores. So it's more about, you know, activating those customers and then just improving their margins, you know, amongst those who are transacting. So they have grown revenue. They've grown average cart size over the same period. So even if their customer base isn't growing, you know, their revenue is growing.
We saw as well a filing by ARM for its mega listing. I believe it was a filing. But yep. What threads are there here for you that you're starting to see evolve in the IPO space? Because I think there was a fair bit of hesitancy for a while, just given what had happened to IPOs in 2021. And now maybe we're turning around?
It looks like we're starting to turn around. This year has been the worst year for IPOs since 2009. We really haven't seen that many blockbuster names hit the market. And Instacart and ARM, those will be the largest IPOs in the US since Rivian in 2021. So definitely starting to signify this turning tide. And ultimately, you have over 1,400 unicorn tech companies sitting in the private markets, many of whom have been waiting for the right opportunity to have an exit. Their investors are ready for an exit. Their employees who maybe have gotten some liquidity but are looking for, you know, broader liquidity are looking for an exit. And I think the fact that, you know, while there's been some recent market volatility, you have the NASDAQ up 30%. You've seen a few successful IPOs, though not tech IPOs, like Kava, Oddity, and Kenvue hit the market. People are feeling a little bit more comfortable, like this may be the time if they're looking to exit this year.
I think for a lot of investors, I think for me, the thing that jumped out at me is, as Simone was mentioning earlier, the dramatic reduction in valuation. I think that's kind of been a gating issue for a lot of these companies not tapping the public markets because they didn't want to take that big write down on valuation. Is the expectation that maybe Instacart will maybe open the way for more companies to kind of bite the bullet, if you will?
Absolutely. I think Instacart doing this and kind of taking it on the chin is going to open the door for others who realize like it'll become less taboo, essentially, as more companies accept these valuation write-downs. It becomes less of a, you know, a negative and just more a reflection of how multiples have corrected. So I do think that they will make it easier for other companies doing this as well. You know, Klaviyo is another company, a marketing automation platform that also